All right. Welcome, everybody, to the official JPow stream at the National Association of Banking something that he's speaking at today. This is one of those speeches that is likely going to last for about an hour. He'll probably talk for like 20 minutes, and then he's going to do a Q&A with the moderator. What are they going to talk about? Most likely, in my opinion, they're going to be talking about the state of the economy, how the Fed has resolved inflation, not literally solved it, but is resolving the problem of inflation that we've had over the past 2 years, while keeping unemployment steady at 4.2 to 4.3, and also allowing GDP growth to be upwards of 2.5%, which is really good. I mean, at the end of the day, getting inflation to come down, getting GDP growth to accelerate, and getting unemployment to stay steady is, that's kind of what the Fed has been trying to do for a while. So I think today we're basically going to get JPow speaking on how he's doing it and what's happening. Now, the thing that's going to be really important about this one is that the 10-year bond is still up. JPow has wanted this 10-year to go down since they cut rates by 50 bips. And that has not necessarily happened. So I think we might get some commentary from him today that tries to do what he wanted to do when he cut rates by 50 bips. Maybe he will be successful, maybe not. But I think we might see some level of potential dovishness from JPow to try to get those rates to start coming down in a way that he's been wanting to get them to come down. And, maybe he cares about that, maybe he doesn't care about that. But I think overall, we might get a little bit more of a dovish JPow. I don't see a real reason for him to be hawkish. We did have Goolsby come out today. You got HIMS right here up 3.74% of the day. Goolsby did say, hey, expect more rate cuts. And then I think Bostic said, if we see more labor market weakness, we'll do more rate cuts. I think that's irrelevant. I think they're doing rate cuts regardless of what the labor market looks like, because inflation is coming down and they obviously don't want to have interest rates as tight as they are. They also want to have a soft landing. To have a soft landing, you need to begin the process of cutting rates. The market is expecting rate cuts. So there's going to be a rate cut. The headlines today we got from Bostic and Goolsby talking about, we might do rate cuts if we have labor weakness. Is like, they're going to do rate cuts regardless. And we know labor markets are not, at the soaring levels like they were back in 2021. So I think we're going to get the rate cuts. The question is going to be how JPow navigates the conversation around future rate cuts and what it means for inflation, GDP, unemployment, etc. We got Robinhood right here down about 1.44% on the day, 23.55. Palantir 36.92. We did hit 37 today for like a couple minutes, 37.15. Yeah, right here, 37.15, just an hour ago. Now at 36.92, still green on the day. Nvidia still red. Carnival Cruise still down 2.2%. Apple still holding 230s really well because of that China stimulus. Rocket Lab right here at 988, up about 1% on the day. Bitcoin kind of flat, down about 1.5%, 63,575. It was at 66 all week. Now it's down today, so kind of chilling out in that 63 range. Tesla right here at 259. It was at 262 in the day. Alibaba. Now, one thing about China, China just went red. FXI, large cap ETF for China, it's red. It's not green. It's down 0.5% on the day. Now, some of the Chinese stocks are still up, but NIO was up 18%. Now it's up 5%. JD was up like 8%. Now it's up 2%. And BABA was up 5%. Now BABA's up 0.28%. I don't know if that is something that's concerning or if that's just people taking profits, but seeing FXI go red today, I mean, China has quite literally gone red just now. And I guess, maybe people are taking profits after a really good week that China had. But if this continues, maybe the market's not believing the China stimulus is as aggressive as they think it is. I personally think it's pretty aggressive, but we're going to have to see how the market interprets that. So China goes slightly red. MicroStrategy down about 2.85. Snowflake's up a little bit. Netflix up a little bit. Really, I think we're going to get some market moves based on what JPow says. S&P 500 right here at 571.38, literally flat. It is down 0.01% of the day. It is waiting for what JPow has to say. QQQ also flat, 46.19. That one also waiting for what JPow has to say. And so we'll see. It'll start in about 5 minutes. And we'll see what he has to say. I'm Beneficial. What's up? Sam Bad, Jed, Lena, Julie Law. Thank you all for being here today. Broccoli Bob, Turtoise Tom from Massachusetts. Thank you for being here. Now I have to say your name every time. Garcia, what's up? It's not my birthday for anyone seeing this comment. My birthday is October 27th. It is not today. But we're getting closer. Dude, I'll be turning 27 years old on October 27th. So we are getting up there. Dougie Dallas, what's up? Gene, what's up? these meetings aren't really movers from what I remember in the past. Yeah, that's fair. I just think everything is so, people are so anxious right now for what JPow is going to have to say. So maybe it's a market mover, maybe not, but I think people will be listening. And people are definitely going to be curious about what Mr. Powell has to say. I love that we get so excited when JPow speaks. It's like there's not that many people in the world that get so excited about him, but we all get excited, which is kind of fun. Admit your UNC status. Yeah, 27 years old is UNC status. All right, let's get a little bit of an update before JPow speaks, and then we'll keep going.
Both in August and September, it was that first week of the month where the market started to get cold feet, started worry about ISMs, started worry about the monthly jobs report. That's the week we're in right now. Maybe it's too cute to expect it to be exactly the same path 3 months in a row, though.
And we'll get, obviously, a jobs number on Friday, I guess. So we'll have one more data point, and I think the Fed is obviously looking at two main areas. One is employment concerns and whether the employment market is slowing, and on the other hand is inflation slowing. Mike, thanks very much. We're going to go, I guess Chairman Powell is starting his remarks, or we're going to go to Steve Leisman here. Let's go to Steve Leisman, who has an early look at the draft of the remarks. Steve.
Hey, Tyler, Fed Chair.
Okay, so he's not starting. He'll starting in a couple minutes, and then we'll see. So apparently, I've been saying Doug's name wrong for months. I've been saying Dougie Dallas. It's Dougie Dolas. Dougie Dolas. I'm just going to keep calling you Dougie Dallas now, dude. I got to call you Dougie Dallas. So Dougie Dallas is what I'll say, even though your name is Dougie Dolas. I like your cap, AI Myth. Thank you. A lot of people are asking if this is merch. This is not merch. Palantir got me this hat. Specifically, Natalie, who is one of the girls I worked with at the Palantir halftime show. She got me this hat. So, yeah, it's no merch, but it is a pretty cool hat. All right, so JPow will be speaking in literally 3 minutes. Oh, he's already started? All right, here we go. CNBC has it. He's already starting, I think. Here we go.
Comments on the economy and monetary policy, and then I look forward to our discussion. Our economy is strong overall and has made significant progress over the past 2 years toward achieving our dual mandate goals of maximum employment and stable prices. Labor market conditions are solid, having cooled from their previously overheated state. Inflation has eased, and my FOMC colleagues and I have greater confidence that it is on a sustainable path back to 2%. At our meeting earlier this month, we reduced the level of policy restraint by lowering the target range for the federal funds rate by a half percentage point. That decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in an environment of moderate economic growth and inflation moving sustainably down to our objective. Turning to the labor market briefly, many indicators show that the labor market is solid. To mention just a few, the unemployment rate is well within the range of estimates of its natural rate. Layoffs are low. The labor force participation rate of prime age workers is near its historic high, and the prime age women's participation rate has continued to reach new all-time highs. Real wages are increasing at a solid pace, broadly in line with gains in productivity. The ratio of job openings to unemployed workers has moved down steadily, but remains just above 1, so that there are still more open positions than there are people seeking work. Prior to 2019, that was rarely the case. Still, labor markets have clearly cooled over the past year. Workers now view jobs as somewhat less available than they were in 2019. The moderation in job growth and the increase in labor supply have led the unemployment rate to increase to 4.2%, still low by historical standards. We do not believe that we need to see further cooling in labor market conditions to achieve 2% inflation. Turning then to inflation, over the most recent 12 months, headline and core inflation were 2.2% and 2.7% respectively. Disinflation has been broad-based, and recent data indicate further progress toward a sustained return to 2%. Core goods prices have fallen 0.5% over the past year, close to their pre-pandemic pace, as supply bottlenecks have eased. Outside of housing services, core services inflation is also close to its pre-pandemic pace. Housing services inflation continues to decline, but sluggishly. The growth rate in rents charged to new tenants remains low. As long as that remains the case, housing services inflation will continue to decline. Broader economic conditions also set the table for further disinflation. The labor market is now roughly in balance. Longer run inflation expectations remain well anchored. Turning to monetary policy. Over the past year, we have continued to see solid growth and healthy gains in the labor force and in productivity. Our goal all along has been to restore price stability without the kind of painful rise in unemployment that has frequently accompanied efforts to bring down high inflation. That would be a highly desirable result for the communities, families, and businesses we serve. While that task is not complete, we have made a good deal of progress toward that outcome. For much of the past 3 years, inflation ran well above our goal, and the labor market was extremely tight. Appropriately, our focus was on bringing down inflation. By keeping monetary policy restrictive, we helped restore the balance between overall supply and demand in the economy. That patient approach has paid dividends. Inflation is now much closer to our 2% objective. Today, we see the risks to achieving our employment and inflation goals as roughly in balance. Our policy rate had been at a 2-decade high since the July 2023 meeting. At the time of that meeting, core inflation was 4.2%, well above our target, and unemployment was 3.5%, near a 50-year low. In the 14 months since the July 2023 meeting, inflation has moved down and unemployment has moved up, in both cases significantly. It was time for a recalibration of our policy stance to reflect progress toward our goals, as well as the changed balance of risks. As I mentioned, our decision to reduce our policy rate by 50 basis points reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate economic growth and inflation moving down sustainably to 2%. Looking forward, if the economy evolves broadly as expected, policy will move over time toward a more neutral stance. But we are not on any preset course. The risks are two-sided, and we will continue to make our decisions meeting by meeting. As we consider additional policy adjustments, we will carefully assess incoming data, the evolving outlook, and the balance of risks. Overall, the economy is in solid shape. We intend to use our tools to keep it there. We remain resolute in our commitment to our maximum employment and price stability mandates, and everything we do is in service to our public mission. With that, thank you very much, and I look forward to our conversation. Thank you.
All right.
Thank you so much. Short and sweet. So here we are in Tennessee. We've had a major hurricane move through. It's top of mind. You know, when so I thought to bring it up right at the beginning. Does the Fed have a role to play when natural disaster strikes?
So let me just say, like everyone, we see the tragic loss of life and the terrible disruption of millions, literally millions of people, including here in Tennessee. We have a couple of things that we do in these situations. One is that we're encouraging bankers to work with their affected customers in affected areas. And the second thing is that sometimes in these situations when power is out, there's a need for cash. And so we find that as a very important thing in these disaster situations. And so we have the ability through the reserve banks to make sure that the banks have available cash so that if power is out for a significant amount of time, there's enough cash to do transactions. But you know, obviously we're mainly on the sidelines and you know, sympathizing with this very difficult situation people are in.
Great. You, in your prepared remarks, you walked us through the decision to begin cutting rates. What has happened, though, since the September meeting? What's new since the September meeting?
Since the September meeting, so most of the data that we'll see before our next meeting hasn't come yet, of course, and we can talk about that. But I would say, one thing worth pointing to is the annual NIPA revisions, which I thought were quite interesting. And I'd point out a couple things. First, as this audience will know well, there are two ways of measuring output in the economy. There are many ways, but two principal ways are gross domestic income versus gross domestic product. So GDI versus GDP. There's lore and there's research that says that actually GDI, gross domestic income, gives a better real-time reading. And for the last year and a half or so, GDI has been quite low relative to GDP, raising, for those of us who forecast the economy, the risk that the GDP will turn out to have been overstated and it'll get revised down to meet GDI. So that's been a downside risk that we've been monitoring. As this audience will well know, quite the opposite happened, and there were very large, adjustments to revisions to GDI, and there's now no gap between the two. In theory, there should be no gap. It's no statistical error in measurement. So that kind of, I would say, removes a downside risk to the economy. Secondly, it has looked as though consumers were spending more than their income. We see disposable personal income now being estimated up. And so that's no longer the case. Again, removing what we've been thinking of as a possible downside risk that the level of consumer spending might be unsustainable. So we look at that, and again, it looks, these were very large, healthy upward revisions to income. And
so we had income was revised upward, spending was revised upward, but income was revised upward so much more so than spending that the savings rate came up.
That's right.
Even with greater spending.
Yeah, the savings rate too. So we think savings are now, there are more savings on people's balance sheet and the savings rate is higher. So that speaks of more kind of background that suggests that spending can continue at a healthy level. I'll just mention quickly two other things that I thought were interesting. One was just another modest increase in estimated productivity. We can talk more about that, but of course we're watching the situation with productivity. Productivity is very important to potential output, and the question is, are we seeing rising productivity which will be sustained over a period of time? And of course, I think it's way too early to say that. Nonetheless, you do see some increase in productivity because we've increased income, but not hours worked. The last thing, and maybe the most significant though, is there's a bit of a tension between the labor market data, which speaks of a cooling labor market, and the spending data, the GDP data, and which has been quite solid. And I would say that tension has not been resolved, unlike a couple of the others. Nonetheless, I would say though that if you take away from this, as I do, that you can be somewhat more comfortable with the spending data, that may also help with the employment data.
So if the economy, so GDI, it was pretty significant upward revisions. GDP also was revised upward somewhat. And so when there's strength in the economy like that, does that give you some sort of sense or more of a sense of security when you're seeing a cooling labor market that maybe the worst outcomes won't happen if GDP is still that strong?
So the answer is ultimately yes, but I would add though that I think there's a lot of thinking that the labor market may give a better real-time picture in some cases than does GDP data. So if you look back over prior downturns, you'll often see that they weren't well predicted by GDP data, but they were by one or more aspects of the labor market. Now, we don't see that happening. There's really nothing that I can point to in the economy that suggests that a downturn is more likely than it is at any time. So we don't see that, but I would say seeing that there's more support for thinking that the GDP readings we get are solid. I think that does happen. It helps at the margin. That's not going to stop us from looking very carefully at the labor market data, though.
Okay. So I have a few questions here on unemployment. The first is related to the summary of economic projections, and then the second is related to state versus national rates of unemployment. So in the summary of economic projections, the median participant has the unemployment rate moving from 4.2% today to 4.4% by the end of the year. So continued drift upward. And yet the median expects that the pace of rate cuts will move down as the unemployment rate continues to move up. How do you square that picture? How do you explain that?
Well, remember that the summary of economic projections is really just a tabulation of the individual 19 participants. So it doesn't come from one sort of consistent thing. But I can tell you why I think people will have written up a couple more tenths of unemployment. It would just be that, as we've seen, the level of job creation is maybe not quite at the level it needs to be to hold unemployment constant, given assumptions about supply. That would make sense to me. I think everyone at this point is looking at their forecasts and understanding that there are great uncertainty bands around it. But the SEP asks you to write down your most likely case, whether you want to or not. And so that's what it is.
So sort of a love-hate relationship with the summary of economic projections?
That's not unfair.
Not for you personally, but yeah. Is there
I would say it's sometimes people can pay too much attention to it. I will say though, one thing is we do it, as this audience well knows, we do it once a quarter, and over the course of a full quarter, the old SEP can get pretty rusty, But for a few weeks after the meeting, after we write down the SEP, it's actually a pretty good read on what the thinking of the committee is. And one thing I will point to is that if you look at the path that people wrote down, we had 10 people at 4 cuts or more, or 2 remaining cuts. We had 19 people at 3 or more. But the sense of the committee, this is not a committee that feels like it's in a hurry to cut rates quickly. It's a committee that wants to be guided. Ultimately, we will be guided by the incoming data. And if the economy slows more than we expect, then we can cut faster. If it slows less than we expect, we can cut slower. And that's really what's going to decide it. But I think from a base case standpoint, we're looking at it as a process that will play out over some time, not something that we need to go fast on. It's more, it'll depend on the data, the speed at which we actually go.
Yeah, so before I get to that second question on the unemployment rate, I'm going to ask you a point blank question here. How are you thinking about the November meeting?
So a couple things. One, we have 2 employment reports and an inflation report coming in. So the main thing will be to look, when we get to that meeting, at the totality of the data, and we're looking at the activity data, the unemployment data, and the inflation data, and asking ourselves, is our policy stance in the place where it needs to be for us to best foster achievement of our goals? And I think we'll take everything into account, and we don't have that data yet. So that's the main thing. But the other thing is just, I wanted to point out, and I kind of just did, that it's a committee that we will do what it takes in terms of the speed with which we move. But if you look at where we were 2 weeks ago, coming up on 3 weeks ago, I guess, when we wrote down our SEPs and made our decision, it was a situation where people were thinking, the bulk of the committee was at 75 or 100 basis points, and the votes were on 50, and that would mean 2 more cuts. It wouldn't mean more 50s. Now, of course, that'll depend on the data, but ultimately that's what the baseline is. If the economy performs as expected, then that would mean 2 more cuts this year, a total of 50 more.
Okay. Question from the audience now. The regional bank presidents know their districts very well, and they come into the FOMC meeting, and well, even before that, the Beige Book, right, provides that snapshot of what's going on around the country. And so we focus on the national unemployment rate, but there are state unemployment rates as well. Are there certain states that are primarily responsible for driving up the unemployment rate nationally? Is it something that's more broad-based? And how would you weigh sort of national versus state level?
I mean, at the end of the day, we're looking at the national aggregate levels, but the real value, one of the great values of the Reserve Bank system is we get, detailed reports of what's happening in the districts, which really start with the directors of the branches and the main banks, who come in and talk to they talk to the staff and also to the president of the Reserve Bank. And I think the banks just do a great job of gathering data and anecdotal information too about what's going on in the district. This is enormously useful to us who are sitting in the center and don't have that range of context or that. So I think it's quite useful. But at the end of the day, we have to go on national data. Although, of course, there are there are different things. It's a big country, a big economy. There are parts of the country that are, doing better than others.
In your prepared remarks, you mentioned about job finding prospects. We have Dana Peterson here, chief economist from the Conference Board. The Conference Board had data recently showing that folks feel like it's getting harder to find a job. Does that, one, concern you? And two, how do you weigh sort of survey data versus hard data like a job openings and labor turnover survey, for instance?
We look at everything, of course, and in particular, the job finding rate has come down very significantly. And so if you're out of work now, it's going to be harder to find a job than it was 2 years ago when the labor market was extremely tight, where you would have had multiple employers waiting for you outside the building to give you offers. Now it's much more at a normal level, or even perhaps a little bit soft. So the job finding rate is much lower. So by so many measures, the labor market is still solid, but it really has cooled. I mentioned vacancies relative to actual unemployed people who are looking for jobs. So they're counted as unemployed. That is right around 1.1 ratio. That was a tight labor market before the pandemic. But it's less tight now. That number was at 2.0 and it's worked its way down. Like so many measures, quits, all of those wages, they point to the same thing, which is a labor market that's still strong, where conditions have cooled considerably. And as I mentioned, we don't think that labor market conditions need to cool further from where they are. Just to take the unemployment rate, it's substantially higher. 4.2% is substantially higher than where unemployment was in 2019. And inflation was below 2% 2019. Take a broad set of conditions, look at 2019. That was not a high inflation environment. So this is not a problem with excessively tight labor markets causing inflation.
I'm so glad that someone submitted a question on housing inflation. I'm sure you're so glad as well. And so I'm going to ask it because we haven't really talked about inflation yet. You made a great point in your prepared remarks that it's running right around, 3-month annualized pace is running right around 2%. So housing inflation has been a large contributor to the overall inflation and continues to be an issue throughout the country. Eroding wage gains. And although housing costs are not a dual mandate, how is the housing market factored into decision-making by the Fed?
So, we think of core inflation as 3 buckets: goods inflation, non-housing services, which is by far the biggest bucket, and then housing services, and that's rents and also owner's equivalent rent. The first 2 have looked like they've, broadly speaking, moved back to their pre-pandemic level. Housing services inflation has not yet. And what's happened is that what should happen is when market rents drop, as leases turn over, when the increase in market rents drops to a low level as it has, as leases turn over year upon year, you should see housing services inflation flatten out. And you are seeing that, but you're seeing it just at a sluggish pace, as sluggish as it usually. So I think I went from thinking at the beginning that this would happen fairly quickly to now thinking that process will play out over a period of some years, 2, 3, 4 years. Nonetheless, as long as market rents, actual new leases as long as inflation in those rents, those leases is relatively low, it's going to show up in housing services inflation as well. It's just going to take, my guess is it's just going to take longer than we've been expecting and longer than we've wanted. But I think, the direction of travel is clear as long as market rate inflation remains relatively low, which it still does. So
the goods side of that equation, goods prices are less under the control of the Fed, but we have been sort of moving back to our previous regime of deflation in goods prices. Some of that is probably sluggish growth from China, but how much do you rely on goods prices being in deflation in order to help that overall aggregate inflation?
Well, so if you
number?
go back before the pandemic, you had, as you pointed out, you had mild deflation in goods for, globalization reasons and other reasons. And, so you take those three buckets I talked about together, they produced inflation between 1.7 and 2%. So we're trying to get back to a world where inflation is 2%. And the combination of those three buckets is less important than the fact that you get the aggregate back. So I just pointed out that goods inflation is kind of back to where it was, and so is non-housing services, and that's most of the inflation bucket. But the third one is not there. Any combination of those things will do, but I think it really looks like the third over time is going back down to where we would like it to be, which is at a level which won't be 2%. It'll be a little higher than 2%, but that will make the aggregate 2%, right in the range of 2%.
So you're going to be embarking on a review of the framework, and inflation, the behavior of inflation since the framework change in 2020, do you think that will inform, or how well will that inform the discussions when you do start the process of going through that 5-year review again?
So we're starting our second 5-year review late this year. So we haven't started yet. We're just now in the process of kind of laying out all the questions we're going to ask and assigning the memos and doing that kind of thing. We're not really ready to roll that out yet. But of course, we're going to be asking, how should we change our framework, which is embodied in the Statement on Longer Run Goals and Monetary Policy? How should we adapt that to what we now understand to be the way the economy works? What have we learned from the last 5 years? And that's what we'll be doing. So we'll be asking all of those questions and giving our answer.
5 years has flown by. I can't believe we're already up on another review of the framework.
Can't believe it.
It feels like yesterday.
I know.
So let me ask you, because you talked a few times about the data that you're going to receive before the November meeting. And one of those data points, most notable being an employment report that comes out during blackout. Some time ago, the blackout period around Fed meetings was extended. And I can tell you that as a longtime Fed watcher, I loved it when the blackout period was extended, because it was almost like a sleep while the baby sleeps. So I could relax longer leading up to the meeting, because we could all sort of take a break. And I also used to have a saying that and this was my personal saying, the Fed does not react well to late breaking news. And it was my way of saying, once you went into blackout, that was it. The data in hand determined that meeting. But it feels like more so over the last year or two, data, and maybe it's the volatility around the data is being considered during the blackout period. Maybe it always was, it just wasn't that volatile. Even policymakers have talked about, and yourself, data that was released during blackout leading up to the meeting. So what does that mean for an employment report that's released during blackout just ahead of the November meeting?
I mean, it depends on the broader situation, but if it's a really important employment report, you should assume we haven't made a decision until we see it. And we're absolutely going to take into account important data that comes in during the blackout period. It gets harder when it's like this, the morning of the second day of the meeting. It's harder to do that.
Yeah.
But, because, everything, it's a big machine. But if it comes out during the blackout period, you should just, going into that, you should just assume that what happens there could really matter for the decision. If that makes sense, there might be a situation where that wouldn't make sense. But I think in the world we're in right now, then, we're going to be looking carefully at the data, even though it's in blackout. Absolutely.
And if this is right, then even during the deliberations, during the FOMC meeting, policymakers do have the ability to change their thinking or their forecasts or their views during that meeting.
Yes, I mean, we do a lot of work, during blackout. We spend a lot of time. I talk to every participant on the Thursday and Friday before the meeting in detail about the economy and what they're hearing. And so there's a lot of discussion that goes on. And ideally, what we discuss in the meeting is kind of a synthesis of all of the views and information that we're all sharing with each other. So, but you should just assume though that decisions don't get made until the meeting. They're not going to be made. I mean, sometimes there isn't really a decision to make, right? It's pretty obvious what we're going to do. Other times, when there is a serious decision to make, you should just assume that it gets made with as much information as possible. If you make the decision before you get all the information, you're throwing away, some information there. You wouldn't do that.
Yeah. So when you began hiking the federal funds rate in 2022, the focus has been on the policy lags, sort of long and variable, but who knows how long or how variable. And so, it seemed like the lags were longer than we thought they would be on the way up. Does that mean that the lags may be longer on the way down? And how do you gauge whether those lags are changing?
This is a very hard part of it. You can't really know. Even now, we can't really know why what's happening is happening. People will be debating in 25 years whether what's happening now with the cooling labor market is due to policy lags or due to something else. So we can't know. What we can know is that what we believe is that policy works with long and variable lags, and we have to take that into account in our thinking, and we do. It's challenging. On the other hand, just take the current situation. What you see is solid growth in the economy. And what you see is a solid labor market. So in a way, the measures we're taking now are really due to the fact that our stance is due to be recalibrated, but at a time when the economy is in solid condition. That's what we're doing. We're recalibrating policy to maintain the strength in the economy, not because of weakness in the economy.
The transcripts are released every 5 years. And so I believe it's January of 2025 that we'll first get a look at the 2019 transcripts. And 5 years ago, you may recall that you were cutting rates. So give us a peek, if you will, into what the transcripts might show around the deliberations you were having at that time as to what were you seeing in the national and the international economy that would drive you to make that rate adjustment, and what did you see that made you feel like you had done enough?
It's a very different situation than the current one, I guess I'd start by saying. But so if you remember, we had raised rates very slowly, I think a total of 9 times to maybe 2.25% and 2.5%. And what my colleagues and I were feeling in 2019 was significant global economic weakness, and also some weakness in the United States economy, and also just a lot of, this was a time of a lot of trade issues, and it was markets were really uncomfortable, and business sentiment was very concerned. So we cut 3 times. And I felt like at the end of the year, I really felt like it had worked well to settle things down. And so we were still, at 175 basis points or something like that. That was that situation. Current situation is one where we raised really quickly to the highest level in 20 years, policy being at about 5.3%, 5.25% to 5.5%, to help with inflation in a world where we had the highest inflation in a long time. And then I think if you take a snapshot of our policy stance, which we put in place in July of 23, and look at I did this in my remarks, unemployment was 3.5%, really tight, and inflation was 4.2 or 3%. So now look where we are. We're at 4.2% unemployment and 2.5% ish in inflation. So the stance that we put in place 14 months ago is not the stance that we need now. It's time to recalibrate. And I think we held on for a long time. And I think we did the right thing. I mean, history will tell, but I think we wanted to get confident about inflation so we wouldn't be in a situation where inflation could just come right back. And so we held on long enough that I think we're more confident so this is quite a different situation than 19, but that's how I remember 19.
Do you think that the 50 basis points that you delivered in September, that cut you described as a strong start, did that cut give you more confidence in the soft landing?
I would put it this way. It's a reflection of our confidence that inflation is moving sustainably down, our growing confidence that it's moving sustainably down to 2%. You know, as I mentioned, our design overall is to achieve disinflation down to 2% without the kind of painful increase in unemployment that has often come with disinflation processes. So that's been our goal all along. We've made progress toward it. We haven't completed that task. I think you'll see us using our tool, you know, in a way that shows our commitment to achieving that. In terms of, I don't want to make a judgment about its likelihood. I just want to know that want you to know that we're committed to using our tools to do everything we can to achieve that outcome.
Well, you know, economists every day were asked to put a probability on the soft landing. I try very artfully to avoid it, and I'll just put it as I have high hopes. So the unemployment rate though has risen. And so should folks be focused more on the delta, the change in the unemployment rate from that very low 3.4, 3.5 to now 4.2, or the fact that 4.2 is only 0.2 above where the committee believes full employment to be, if we can have any confidence of where we think full employment is? And how would parsing demand versus supply in that rise in the unemployment rate factor in?
I mean, the change that we've experienced in the unemployment rate is information, and we shouldn't reject that for what it's worth. It's information. We should know it and consider it. And is it telling us something about future movements in that direction? We can't know that, but that's the question. So, you know, we're not going to ignore that. I think also the level of, and the reason why unemployment has moved up too is also important. But the level is still a level that is, I mean, I remember when I joined the Fed in 2012, I remember unemployment going down below 6 and then down below 5. And people were really thinking, wow, we're in the 4s. This is really low. You know, 4.9% was considered to be perhaps below the natural rate. Now we're talking about 4.2. So I think you need to keep that in context. In terms of supply and demand, you know, it's really down to the level of payroll job creation has come down pretty significantly from where it was earlier this year and certainly in prior years. It's 116,000 a month for the last 3 months, and that's without the QCEW adjustment, which would tend to suggest that that'll be revised down significantly in time if the QCEW adjustment is sending an accurate signal about what's happening now.
Those are the preliminary annual benchmark revisions.
Yes, through March.
Right.
That's right. So, you know, I think you look at all of it, you've got a solid labor market, and, you know, we are recalibrating our policy stance, and we'll continue to do so going forward in order to maintain that position.
And when you talk about following the totality of the data, obviously in the US, we enjoy really a good deal amount more of government sources than I think other countries. We have a lot of private sources for data. And so this is a shameless plug for NABE, really, because I wouldn't be president without it. But Svenja Gudell, who is the chief economist of Indeed, is a valuable member. And Indeed, LinkedIn, ADP, they all put great monthly reports out on the dynamics of the labor market from millions of data points, really, that they track. How do you take into account, sort of say, a JOLTS, which is an official government source for the flows in and out of the labor market, versus what some of the private sources show? How closely do your economists follow that?
Oh, really closely. Yeah. You know, of course, we look at JOLTS, we look at Indeed. You know, you can pick out any of these and critique it, but I think the bigger picture is that the business of collecting data about the U.S. economy and analyzing it is really one of the great achievements of our country, frankly. You know, we're committed to doing everything science allows us to do to understand what's going on in the economy. Understanding it perfectly is impossible. But we do everything, we do some of this at the Fed. Mostly this is not done at the Fed, but the collection of data and the information that we get are as good as it can possibly be. And I think basically it's a great success story about our country and about our economy, I think, overall.
Yeah, maybe another shameless plug is just that NABE is a very strong supporter of funding data agencies at the government level to ensure healthy, reliable, and sound data sets. Just saying. So given that you're talking to a room full of economists, I'd love to get a sense of how you all at the Fed use your economists. You have just a few at the Fed. I think 150 or so, I'm not sure, but it's a lot. And maybe, when you're in the committee meeting itself, how do you use the economists to give you updates, to give you the data that you need to help you make decisions?
We have a lot more than 150 economists.
Okay. I knew it was a big number.
It's a big number, but
Are you hiring?
It's
For the NABE scholars.
We're always hiring, always. We're an interesting organization, and we have very large number of PhD economists, but we also have policy-making responsibilities in monetary policy, in payments, and financial regulation. And so we're kind of, on the line between academics and policymaking, very important policymaking. The economists that we have, I would say this about the other professionals that we have, they're incredibly important to the work that we do. The way I experience it is I meet regularly with different groups of economists, but if I have a question about something, often about the labor market or inflation or anything, I'll get an answer, but usually I get a group of people, and these will turn out to be people who have spent 30 years or 20 years thinking about that very question, and there might be 2 or 3 different opinions or way to approach that problem in the room. So people, they feel free to disagree with each other, and they also feel free to disagree with us, with the policymakers, and we feel free to disagree with them. I mean, it's a very healthy dynamic, but these are, so many of these people, they're wonderful people. They're incredibly committed public servants. I'm deeply honored to get to work with these people. And I think I think the Fed is a great place to work for an economist. One of them said to me, one of the most senior ones said, if all we could do around here was just sit around and analyze and talk about the economy, we'd have the best jobs in the world. All the policy making is hard, but ultimately it's really fun and enjoyable to analyze and discuss the economy. We could all spend our whole lives doing that, but we have other responsibilities too.
Just a few.
You can probably relate to that. Yeah.
Well, I think even you and I have had a conversation where you said, I like nerding out with the economists, and we appreciate that. Yeah. I'm glad that you do.
I speak economies.
You speak economist. Yeah. It's a whole different language. So in our last minutes here, sandwiched between you and Alon Collette at the lunch table, lots of talk around, I hear guitars, I hear blues music, I hear comparing every band that's your favorite and albums. And I feel like that's been the conversation of this whole conference. As Alon said, we were at the Johnny Cash Museum last night. Nashville is just a phenomenal place. And so if you were to be able to stay over, what would you do this evening in Nashville?
I would certainly visit the Patsy Cline Museum and the Johnny Cash Museum. Big Patsy Cline fan. I like this kind of music. I like music way too much. The other thing is there's a band that it turns out Alon's going to see tonight called the Time Jumpers. And it's basically the best studio musicians in Nashville and hence in the world, really, in the kind of music they play. And they play at a place called Third and something or other. Third and Lindsley. But it's an excellent band. Vince Gill sits in as the lead singer, but he's not always there. Anyway, that's what I would do. And I've got to come back because I've been a fan of that band for 10 or 15 years and I've never seen them live. So,
well, in about 15 minutes, it's going to be sold out. So
I've got some tickets.
Yeah. Well, yeah.
Sold
already
out.
Is sold out. Oh, gosh. Okay. Should have known. All right. Well, next time then. And for now, thank you so much for giving us your time today, Chair Powell. We really appreciate it.
Thank you. Thanks, Ellen.
And that was Federal Reserve.
This was one of the weirdest JPow meetings I think we've seen in a while. Why? Well, first of all, that camera and that lighting literally felt like it was the 1990s. I mean, I don't understand why it was like that. Number two is market tanked, going back to 1929, as someone mentioned in the comments, which was, I had to tweet a picture of that, dude. That was hilarious. The S&P tanked by 0.5% after, a pretty decent month. And we got 1929 coming out. So first of all, again, I don't know why the lighting and the audio was like that. It was just a really weird setup that they had. And then S&P fell 0.58%. And, that got a lot of us mad. So what did JPow say to cause the markets to fall just now? I don't know. I mean, he kind of sounded hawkish about this idea of cutting soon. And he kind of, the extent of what he said was, hey, we're going to see, what's in the day. Oh, wow. Look at that recovery. Oh my God. As soon as the conference ends, we get a green S&P. We went from 568 to 570. We are now down barely 0.1%. This is hilarious. This is absolutely hilarious. JPow stops talking and we go green. I think at one point he said something like, we're going to let the data determine if we need to keep cutting more aggressively, and it'll be based on unemployment data, labor market data, inflation, etc. And the market kind of interpreted that as, oh, is there a chance we're not going to get another 50 bips? I think that's how the market was like, wait a second. So you're telling us there's a chance we might not get 50 bips. And that statement alone, I think, got the market upset. But I think the reason we're recovering right here is because the market knows there's no way in hell JPow is not going to cut by another 50 bips. The market's already priced it in. The market's pricing in 75 actually by the end of the year. So 50 and 25. And a soft landing requires lower rates to make sure unemployment does not spike. It's just that simple. So if he wants this soft landing, he's got to kind of do what we all expect him to do, which is cut rates, along with the fact that inflation is probably going to be at 2.2 to 2.3 in a couple of weeks when we get the new CPI, because right now we're at 2.5 and core PCE was lower on the monthly and the yearly. So it's very likely that he's going to cut. I think he kind of was trying to sound hawkish to not give too big of a boost to the argument that they're going to cut and get the markets overly exuberant, but we know they're going to cut. And so I think the market's not falling for that argument. Palantir's ripping back up. Where's Palantir? Pretty much everything took a little bit of a dip just now. Yeah, Palantir just went back to 37. Guys, Palantir cannot go down. I mean, I've been covering this stock for 4 years. I have never seen this type of resilience out of this stock. I've just never seen it. The past 3 weeks, let's call it post S&P inclusion. So basically 3 weeks. It's been 3 weeks since we've been in. I have never seen this type of resilience from this stock. 3 weeks into S&P inclusion, Teal and Karp sold a good chunk of shares. You had people who wanted to take their profits, obviously have taken their profits, and the stock does not, it's not giving a dip. It's just incredible what it's doing and how it's holding up. By the way, valuation obviously is stretched right here. Still, the market doesn't care. The market does not care. Now, look, I'm not saying Palantir cannot fall. Okay, so don't get that misinterpreted. Palantir can obviously take a big haircut. Anything could happen. They could miss on earnings, macro, yada yada. I'm just saying, in the past couple of weeks, this stock has been one of the most resilient stocks I've seen in my life, and also Palantir stock in particular has been the most resilient it's been since I've covered it over the past 4 years. I mean, it's just unincredible. It is unincredible. Bank of America says it's going to store its accumulation now. Yeah, that's what I think is happening is right now. I think Bank of America, they came out with their $50 target. We did a video on that a couple of days ago. They are talking about Palantir as the next big thing. And I think a lot of the institutional clients that are reading these research notes, same thing from Wedbush, they're starting to feel, hey, we need to get an allocation to this company. And regardless of 85 billion, which maybe not is the best entry price, I don't think the institutions care. They just want to get in the door. And that's what we're getting for Palantir. So it's holding up pretty nicely. What else do we have right now? So JPow just spoke. What else do we have? We have S&P basically recovering, dude. Look at this V shape. Just incredible. Alibaba still down. So China did fall off a little bit from being green in the morning. Palantir again, another V-shaped recovery right there. SoFi still is down. SoFi still down about 1%, not really getting too much recovery. Rocket Lab now falling about 1%. It hit $10 today. Nvidia down 1.3. Nvidia and the semis are pretty much all down because of that China news about not buying chips from Nvidia, but buying chips from Huawei. And when Nvidia falls, it takes away all the semis with it. So Nvidia's down a little bit, AMD's down, SMCI's down, Intel's down, ASML's down, Broadcom's down. Micron, I don't know why Micron's now 4%, but it was up 18% last week. So you'd imagine some people are taking profits, but that one's falling as well, with Nvidia and the other semiconductor companies falling down. Bitcoin really didn't like this speech either. Bitcoin almost hit 62,000. Right now we're 63.3. We were like $58 away from hitting 62. So Bitcoin didn't love the speech, but Bitcoin's recovering a little bit right there. And then the S&P is flat. The S&P is flat. Yeah, Oracle's really interesting as well. I mean, look at Oracle's chart today. It's up like 17 cents, but like it took a little bit of a round trip dip and then came right back up as well. Nothing too crazy, dude. Nothing too crazy after that. I don't even know what the point of that meeting was. Like, I guess it was a room full of economists that like wanted to hear JPow speak. I love hearing JPow speak as well, but like really there wasn't anything unique we got from that conversation other than him describing what they've been able to do over the past couple of weeks or past couple of months, obviously with fixing some of the problems with inflation and increase and in maintaining GDP growth. S&P over the past month is up 2.13%. We have about an hour and 15 minutes left until the market closes. If we can hold on to 570 or 571, we are going to close up 2% for the month of September. This has not happened in over 5 years. A good September going into October is not the worst thing in the world, especially in an election year. And it'll be a hell of a month for September if we can close at this 570, 571 range. Even, I mean, look, even as the market tried to fall, got all the way to 568, the dip buyer stepped in. The dip buyer stepped in on Palantir as it fell to 36.75 while JPow was speaking. Like, the dip buyers are ready to buy if they get opportunities. Now, is 568 a dip? Is 36.75 a dip on Palantir? Probably not. But I think the macro landscape, given China pumping or the Saudis pumping oil, China printing money, etc., and GDP growth being good, it's leading more people to believe that any entry price on pullbacks are going to be beneficial, which is what I think we're going to see in October, even if we get some bad dips. Now, look, September was supposed to be a horrible dip, right? And we felt it the first week of September. What happened? It ended up being a pretty exciting month. So maybe October is the same. Maybe October is not going to be as bad as we think. Okay, so usually I do a market close at 3:45 p.m. It's 2:45. I feel like we might as well just stay live for the next hour, and we'll come up with stuff to talk about and analyze, and then we'll do the market close officially at 3:45. So I have a couple things I can show, and we can just talk and go through some stuff, but then at 3:45 we will officially get into the close. And so we'll stay on. So here's one thing I want to show. Palantir went public 4 years ago in 2020. And we actually have a video. Some of you guys might have never seen this video, especially if you're new to Palantir. So I think you guys will enjoy it. This is Palantir CEO Alex Karp talking about them going public the day they went public, September 30th, through a DPO, not IPO. That's something people have to. It was so funny, dude. I saw this Palantir account on Twitter, and their entire account is branded around Palantir, and they're like, "Oh, Palantir's IPO was incredible." It's like they never went through an IPO. It was a DPO. These are some of the basic facts we have to remember. But they did a direct public listing, which was bad for Wall Street because Wall Street didn't get to underwrite the IPO, or in this case, the DPO, even though Wall Street doesn't underwrite a DPO, and make money off of that through fees. They had employees directly sell stock to the public. So employees got liquid, not JP Morgan or Goldman Sachs. Since Palantir went public, they became profitable, joined the S&P 500, launched the most innovative go-to-market sales for AIP bootcamps, hosted 5 AIP cons. I was lucky enough to get to go to 2 of them, won a contract with the NHS to manage their entire healthcare system, power 20% of beds in the US, be the first software company to help power Ukraine, and grow to over 500 customers and close to $3 billion in yearly revenue. And finally, they connected with their passionate retail investor community that believed in the company when Wall Street didn't, by doing it their way. The stock is up 269% since doing a DPO. Here was Karp, September 30th, 4 years ago, talking about why they were going public.
This has been probably one of the most highly anticipated offerings or listings in a very long time. Almost every year that we would talk in Davos, I would invariably ask you, are you going to go public? Are you going to list? And invariably you wouldn't. So let's start with why now?
Well, first of all, thank you for having me. And I really would like to thank all the Palantirians who stuck with us and built this company, and our investors who stuck with us. And, you know, over the years, we've been skeptical about listing, and for lots of reasons. We really needed to build our products with enough protection so that we would be ready to launch them into the public space. And we built out PG, which is our government product, and our Foundry product, and built a way to maintain them so that we wouldn't have to scale the number of people. And, you know, we've reached a base where our company is very significant, and we believe being in the public space will help us with our clients and help us grow. And quite frankly, I believe the people at Palantir who've built this company over 17 years deserved access to liquidity. And so we decided this would be a great time for us. And so far, it's been a really interesting process, and our clients are embracing it. So it's a really good time for us, and I'm very, very grateful.
Alex, the single biggest question that investors ask about this company is 17 years in, while you may have an operating profit, the company unto itself is still not profitable. So walk us through what the path to profitability looks like.
Well, dude, if we could go back and buy those shares at $10, man, knowing what we know, obviously, you know, that's the whole point of investing, but it'd just be wild to just like buy them back at $10.
Well, you know, we build these products years before people build them, and that takes money. And what you see in the COVID pandemic crisis is we had built this way of going to market with Foundry, which would allow us to literally supply an enterprise with a completely new stack of products within 6 hours and maintain them. And what you saw when we did that is we grew the company 49% off of a 743 base. And the divergence between expenses and growth is dramatic. And we're just going to be very, very focused on invigorating our software offering. But when you're growing 49% off of a 740 base, I think that's a pretty strong indication of what the future could hold. And we're super proud of that. And I think you're seeing that people are taking a look at our financials, and our company has often been viewed as complex and needing explanation, both moral and financial. But it turns out our financials are quite simple. And you look at this dramatic growth with flatlining expenses, and I think that gives investors comfort. And it certainly makes me feel as co-founder and CEO that we made the right decision to invest heavily well over a decade in building software the way other people don't build it, and you see the results.
Do you think, though, profitability is a 2022 proposition, a 2023 proposition? Can I push you on that?
Well, you know, you can push me, but of course, my lawyers will shoot me. What I can tell you is
See, bro, who says that, bro? Like, this is what I'm saying. Like, who says that? This was the day he was going public with his company. Who says my lawyers will shoot me? Someone says that when they're just built different. And I think early on, if you saw this a long time ago, you could tell this guy was a bit different, a bit wonky, a bit crazy, you could argue. But sometimes you got to be a little crazy to get things done.
We are very, very focused on building software a long time before other people building it, supplying it. And I think that our first half of the year growth will be reflective of the future. And if I'm right, that will answer all of your interesting questions. And you'll be interviewing me again maybe not at Davos, but virtually. And we'll see how we do. I'm quite confident we'll do well.
Well, Alex, one of the other questions people ask is how to comp your company, meaning what are the comparables? Should this be considered a technology company, a SaaS company, or should this be considered a much more traditional consulting company? Can you speak to that?
Well, I think what the investors are seeing is they're asking the question at this point. They used to ask, is this a company that builds software for the government, and how do they build it? Of course, we always sold this as a license. Then they saw our margins in the first half of the year around 80%. So I think the real debate now has moved significantly away from, is this software, is this services? Because although people think we're very smart, we're not smart enough to get 80% margins off of a services company. The question then is, how do you comp it? And honestly, I think that's something investors will have to figure out. We're not focused on that. We're focused on, we are going to be the most important software company in the world, and people will figure out what that's valued over a long period of time. And we're very comfortable with investors toying around. It could be like this, it could be like that. We are going to deliver the world's best software with the world's most efficient way of delivering it. Investors will decide what's that is worth to them. And I think you'll find in a number of years that there will be a consensus. Palantir is a truly special software company that is arguably the most important software company in the world.
All right, there we go. For those that are just joining about JPow, JPow was JPow. He said nothing that we didn't know. All he said was, we're going to look at the data. The data is going to determine if we continue to cut rates or not. Quite literally, I mean, like I'll read some quotes from what he said, but there was nothing different that he said that we didn't know about. So quotes, policy will move toward a more neutral stance over time if the economy evolves as expected. Risks are two-sided. Decisions will be based on a meeting-by-meeting basis. I mean, is that even worth reading, right? There is growing confidence that inflation is on a sustainable path to 2%. We know that. Housing services inflation will decline if rent growth for new tenants stays low. The 50 bips rate cuts reflects confidence that recalibrating policy will maintain labor market strength and progress toward the inflation goal. That's their dual mandate, right? That he described that in depth a couple of weeks ago at the FOMC meeting. Good progress is made towards restoring price stability without a rise in unemployment, and economic conditions support further disinflation. So inflation's coming down. He wants to make sure the labor market doesn't dramatically go up, which is why I guess the markets are basically flat right here. I mean, they kind of went down when he was talking, but they kind of don't care about what he said to make it go too much higher. Price target for Palantir in 2026. Why doesn't the chat answer that? So let's see. What do you guys think? Palantir 2026, what price? What do you guys think? 2026, right now we're at what, $37, $80 billion market cap? So 2026, we would be doing $6 billion in revenue if we grow at least 35-ish% a year. By 26, around 5.5 billion, something like that. I don't think it's crazy to say 100. I know that's wild, but it would require hyper growth, right? And it would require no recession. Both of those things, I don't know if we're gonna get. So more conservatively, probably 65-ish is where I could see it going if we really accelerate growth. If we have an Nvidia quarter anytime soon, dude, it's gonna go to 100 on the narrative alone. Like if we have an Nvidia quarter, this thing's not, because no. The reason I'm saying this, I'm not trying to sound delusional here. No one's selling. Like no one's selling outside of Teal, and him selling is not even enough to get this thing to go down at 37.04. I'm just saying, bro, I'm looking at the numbers. Like the amount of selling we've had by insiders has been the most egregious since end of 2023, and the stock is green. That means there were so many people willing to take those shares off of Teal's brokerage account and put it into their brokerage account that he had no issue generating liquidity for $600 million worth of stock out of an $82 billion company. Why? Because there's plenty of people willing to buy. And off any piece of good news I think we get on Palantir, there will be more and more people willing to buy, which is good. Now, is that sustainable? I don't know. I mean, I really don't know, but I think at least for the past couple of weeks, we've seen a level of sustainability to it. Maybe that changes in 2025, but so far we are seeing some pretty damn good momentum, and any positive news is only going to continue that momentum as well. Speaking of Palantir, I see a lot of price targets in the chat. Most of you guys are saying 60 to 70, which I think is fair. I think that's reasonable. 60 to 70, I think that's very reasonable. If we want to get aggressive, maybe 80 to 90, round that up to 80 to 100. But I think a lot of that is fair if we get there. Here's a clip I found of Scott Galloway talking about Palantir. I mean, I saw this today and I couldn't believe like these guys are talking about Palantir again. But you're starting to see Palantir again get more media attention everywhere, including on different alternative podcasts. So here's, I think, 3 or 4 minutes of them talking about Palantir, and we'll analyze it right after.
Useful idiots roaming Palo Alto, and it has resonated with retail consumers. And if you look at it, they actually have a much bigger ownership stake amongst retail consumers, and retail consumers tend to be more about momentum and brand than they do about underlying fundamentals. And this company is just trading at kind of a valuation that just quite frankly doesn't make any sense. So is it a great company? Yes. Is he a good CEO? Yes. And he is the new premier storyteller in the world of tech, and his shareholders are benefiting from it.
I do want to sort of double click on this idea of fiduciary duty, especially because, 40% retail ownership, 36 times sales. I think you said something like 220 times earnings. It's pretty clear to me that Palantir is overpriced and something of a meme stock at this point. And it's sort of because of him. And I'd just like to get your take on whether you think that is good or bad management. In other words, a CEO who sort of uses their charisma and uses their storytelling ability to inflate the stock to a price that is quite frankly going to be a little bit unsustainable. I'm wondering if you think that that is an example of fulfilling your fiduciary duty, or is it possible that perhaps it is betraying it?
I think it's the former, Ed. I mean, as a CEO, you're trying to tell a story such that you can pull the future forward, right? Was it irresponsible of me to raise $15 million off a PowerPoint deck at a pre-money valuation of $35 million? Did I have an obligation to my investors to say, I'm just a guy who's 34 with a shaved head. And I don't, I remember after I raised the money thinking, I've committed fraud. I don't know what the fuck I'm doing.
Which company was this?
Brand Farm, my e-commerce incubator backed by Goldman Sachs, JP Morgan, and Maveron back in 1999. We closed in December of 99. And spoiler alert, it didn't turn out well. It was literally like 2 months later, the .bomb implosion. If you have the gift of storytelling, as long as you don't commit fraud and start putting electric vehicles on a mountain such that, and then angling the camera such that it looks like the car actually has an engine in it. I mean, as long as you don't break the law or commit fraud, if your ability to attract cheap capital because of your storytelling, your majesty, your good looks, your charm, we're proud of the progress we've made. We need to do better, whatever it might be. Or Jeffrey Bezos' 1997 shareholder letter. If you read it, you just want to buy stock in the goddamn thing. That ability to raise capital at a cheaper price than your competitors gives you the ability to pull the future forward and maybe grow into that stock price. So what this guy's done is absolutely, I think he's being a great fiduciary. His employees are getting rich, and he's now going to have access to cheaper capital to build out infrastructure, technology, hire better, brighter, faster, smarter people, and make investments his competitors can't keep up with and sort of pull away with it. And that's kind of the job of the CEO. What I would suggest is that anyone that works at Palantir and has options that distinct of how excited you might feel about Alex or your company or your colleagues, that you do one thing: sell. Sell as much as you can right now. You're never going to look back, and I believe, even if the stock goes up, really be pissed off at yourself for selling at 218 times earnings.
We'll be right back after the break with a look at the longshoreman strike.
Interesting. So that's the professor's take right there. Look, I think I agree with Ty. I think it's a reasonable conversation here. I mean, I disagree with calling Palantir a meme stock. You could say that the valuation is stretched right here. I don't necessarily think it's a meme stock, but I think his broader argument is, so one of the guys is asking Scott, hey, the valuation at 85 billion realistically is based on Karp's ability to storytell and his interactions with retail that gets them excited about, how Karp calls out retail in the S&P 500 videos, things like that, right? That's why there's a cult following around the company. At least that's one of the arguments that he's making. I wouldn't disagree with that. I would say there is a big cult following around Palantir, particularly because of Alex Karp. But Scott's argument right there, which is a really good argument against that analysis, is if you can storytell in life, you can win. It's just that simple. If you can storytell, you can win. If you can communicate an effective message to an audience that cares about receiving that message, whether it's investors or whatever it may be, you have the opportunity to influence. And from that influence, you can then get things to go up like a stock price because people are investing in your vision, your idea. By the way, when Palantir had to convince the CIA to invest in them, right, when they were very young, they had to also be able to communicate an idea. So I think that if you're able to storytell and you're able to raise a valuation on a company based on the narrative you're telling, everything at the end of the day in the stock market is based on narratives. Valuations and numbers and metrics, all of these things support a narrative, or they can not support a narrative, but it's all based on a narrative. So this is why, I get so excited to invest in people like Alex Karp or Elon Musk or Vlad Tenev, because these people to me are storytellers, and they can effectively tell a meaningful story backed by a narrative that gets people excited. And they can uniquely do this because they're all founders. And so if Karp can tell a story, then if that story gets people excited, then the price is just based on what people are willing to pay. And so when that story stops getting people excited, and when people lose faith in the story and they don't see the potential, then we're going to see a dramatic decline in the stock. Maybe that happens because they miss on earnings. Maybe that happens because there's a recession and people say, screw it, I'm up 200% on Palantir. I need money to pay my bills. I don't believe that much in the story enough to keep my money invested there. I'm going to take some profits. Like, all these things are revolving around narratives and stories that are very dynamic and volatile, but they are stories at the end of the day. Douglas says Palmer lucky as well. Yeah, 100%. Storytelling, quite frankly, is the basis of like, not just like when you're raising money or trying to get investors, but like anything in life. If you're trying to get a job, you have to tell a good story to the employer, right? If you're trying to like get into a relationship with someone, you're trying to give that other person a story, a narrative, a reason to interact with you. Like storytelling and communication is everything. And I particularly know this because I ran a whole communications consulting firm. I worked with plenty of people over the past 10 years, helping them better communicate. And so when it comes to getting people to buy your stock, it's primarily based, in my opinion, on the story. The numbers have to be there. Like, Palantir can't grow at 10% year over year and have this amazing story. So it's not only the story, but when you've got everything else to get that extra juicy premium of 215 times earnings and 36 price to sales, you got to have a good story. And if you have a good story, you can continue to gain some momentum. That's what leadership requires, 100%. Like, some people will see me talking about this story and they will say, oh, that's just like snake oil salesman BS. I get that perspective, and I don't blame having that perspective. I think of it as leadership because there's a lot of CEOs in the public equity markets that can't talk, that can't galvanize people, that can't get people's attention. What is the economy that we're entering into right now? It's not a war over money. It's a war over attention. Quite literally, it's a war about how can you get people's attention. Whether you're the biggest corporation in the world, you need people's attention, or you're someone building a brand, a startup, whatever. Maybe you need people's attention. If you don't have people's attention, you lose. That's why social media has gotten so much popularity, because it is a democratized form with zero barrier to entry. Literally, you have a password, a username, email, sign up, boom, you can start posting. But that also makes it 1,000 times more difficult to get people's attention, because if everyone's posting, then like, how do you work with the algorithm to get people's attention? The point is, if you can get people's attention, which Palantir has been able to get over the past couple of years, you're going to be able to tell a unique story because you have their attention. That attention can then lead to obviously the stock doing well. And I think Karp just knows how to storytell, which is very, very important. Danielle says there's a legion of great storytellers that can't pronounce Massachusetts now. Exactly. Sometimes you got to know when you're a good storyteller, but you can't pronounce certain words. Cardboard Bay says, you have become my favorite finance guy to watch now. Thanks for all you do. Thanks for being a good, honest person on YouTube. Thank you, Cardboard Bay, for being here. Really appreciate it. By the way, you know that guy I was talking about last week? We got Liz Young on CNBC. We'll listen to her in a second. That guy who's making like day trading TikToks, and he's in college, and he's like watching me in the background. He sent me this message today. I posted it. And the message was, bro, my college professor in international finance just asked the class who uses Robinhood for investing, and about 75% of the class raised their hand. So you're starting to see that wealth transfer narrative start to happen with the young generation. He also transferred $180,000 from his brokerage account over to Robinhood for the 1% match. Now, again, why is this happening? Robinhood has been able to tell a story to the youth that this is a place where they should keep their money. Obviously, there's a lot of incentives and there's all this other stuff we can get into for the thesis, but Vlad has painted a story. And that story is, and for investors, Vlad has painted a story primarily based on user experience and how it's leading to organic growth. And that story is something that Wall Street is understanding. I think at the end of the day, if you're investing in a company, you can't tell the 5 to 10 year story around that company, it's not worth the investment. But if there is a reasonable story, then I think it's an exciting investment, and then the numbers just have to match up to the story. And in the case of Palantir, if they deliver on Q3, the numbers are really going to match up to what the story looks like as well. If a meat eats mayo, Palantir goes to 500 in 2030. Dude, if all I have to do is eat mayo to have my shares be worth $500, I mean, I don't like mayo, but $500 will get you to do some things. All right, let's listen to Liz Young. She was on CNBC this morning, and then we'll keep going from there. Oh, wait, you can't hear it. Sorry.
Liz Young Thomas is with us, head of investment strategy at SoFi. I knew that. How are you? Good morning.
I'm good. Hi, Joe.
We had a great run up to the easing cycle. Does it continue, or is it like so many things where we've already anticipated it and already traded on it, and now the going gets a little tougher? What do you think, Liz?
I think the biggest gains leading up to the easing cycle have probably been had, but that doesn't mean it slows down necessarily in the immediate term. So usually after that first cut, when you look out 30 to 60 days, the market is flat-ish to up. And then about 3 months out is when the market decides whether or not these cuts were needed because things were cooling too quickly, or if they were cuts because we could do it, not because we had to do it, in which case the market ends up being much more positive. So there's a few other things going on, though, that obviously are a tailwind for this rally. We've seen tech give a little bit back, or at least slow down its gains and not be leading the market as much, which you would think is a negative. But what we've seen also is that a lot of other stocks are coming up and really pulling their weight. And with 80% of the S&P still trading above its 200-day moving average, there's a lot of internal strength behind the rally, not to mention the optimism over China stimulus. So I think in the near term, we've got a lot of good things going for the market.
It seems like valuation concerns never helps you really with the timing of when to lighten up. Although, watching what Warren Buffett does can help you sometimes. And we've already seen maybe him lightening up a little. But the reason you like rates to come down is because multiples can expand. But in the United States, aren't we at about 21 or 22 already? Why should unless it spawns more higher earnings, it seems like multiples are already pretty rich.
I would agree. Multiples are if we compare it back to what we do most often right now in the early 2000s, not nearly as rich as they were then. But when you look at where we are today, we're above the 5-year average, we're above the 10-year average. We're not quite at overbought conditions on the S&P, but we're up there. And when you talk about Warren Buffett, he's the longest of long-term investors. So he's obviously not trying to time the multiples on markets. But what you do want to see from this point forward, if we are able to secure a soft landing, you want to see the market start to trade more on fundamentals and not on multiple expansion, which might actually mean mathematically that multiples don't expand that much more from here, but earnings get more steady and stable. And you see some of the other sectors besides tech come in and show some more earnings strength. So we've seen little glimmers of that. We've got obviously a lot of strength in the industrial stocks right now, but not so much strength in financials. So there's still some conflicting signals from the market, but we don't necessarily need it to be multiple expansion. You do want to see fundamental expansion as well.
Well, that's it. Then
So basically she's saying, hey, we can broaden out the rally without needing tech stocks to go all the way to the moon, because there's going to obviously be other companies that are going to benefit on a fundamental basis from the market doing better. Liz has been relatively bearish for the past 2 years. It seems like over the past 6 months, she's changed up her stance, which is fair. Again, with China doing what they're doing and oil prices being the way they are, it's just hard to get bearish unless you are someone named Meet Kevin. So Meet Kevin just tweeted, the market is dumping. Why? Because it finally realizes Jerome Powell is lying to us. Full breakdown coming shortly. He gave a big warning, but markets only heard everything is fine. We're going 25 and 25. I think this guy is losing it, bro. I'm just like, I think he's losing it a little bit. Dumping, this is the dump. I mean, when I say dumping, I'm saying it to be funny. I'm not saying it in a serious way. I think Meet Kevin legit thinks he's serious. Now, look, let me preface this by saying he could be right, and November could be an epic crash after the election. Everything goes to shit. Whether it's Trump or Kamala, the market gets upset. Unemployment spikes up to the roof. Inflation reaccelerates. There's all the bear cases lined up that could happen. It is a question of how probable they are to happen. And when he says the market is dumping at 228, and right now I'm looking at Palantir at 3704, I'm looking at the S&P 500 down 0.18% on the day. I don't know if that's a dump. I don't know if that qualifies as a dump. Looking at the Qs down about 1/3%. I don't know if that's a dump. I think he's trying to win his narrative, and I mean, you could try to win the narrative, but I think the probability of a cataclysmic crash is just starting to go further down to me. And again, we'll get the jobs data this week on Friday. We'll see how jobs are doing. If we add anywhere from 140,000 jobs and higher, I think that's bullish. We're adding more jobs. Labor market's cooling off a bit, even if the Fed only cuts by 25, which I don't think they'll do. I think they'll do 50, but let's say they do 25. That's fine. We'll get another 25, and there you go. You got your 100 bips for the rest of the year, which I don't think is a horrible thing. I mean, again, for the bears to be right, they have to win. There is an acceleration of inflation post the cut, or they have to win the labor market is doing so amazing and we're adding 200, 300,000 jobs that it makes no sense to cut, which if that's the case, I'll give you that argument. If we're adding upwards of a couple 100,000 jobs, yeah, we probably shouldn't be cutting because there is a risk to upside inflation, but that's not happening. We're barely, right? And so if we're barely adding 120,000 jobs, I think it behooves us to think maybe we want to make sure we cut to make sure things don't necessarily end up in a recessionary collapse. Now, we did get this article by The Verge as well that I want to pull up around some things with chips. So let me pull that up and see what we have to say here as well. Shout out to Baspa. Hi, Amit. Found you on YouTube 2 months ago after getting laid off from a tech job. Really enjoying your channel as I started day trading. BTW, Hellman's rules. Okay, I disagree with your last sentence, but thank you, Baspa, for being here. Really appreciate it. I'm sorry that you got laid off, but thank you for being here. And hopefully your journey into the stock market and with day trading is going well. And hopefully the channel is helping you with that as well. You know, what's interesting is I don't know your financial situation, but if you got laid off from a tech job, I would imagine, if you've been working at that tech job and saving up some money, tech workers have a decent amount, hopefully saved, given your salaries are a bit higher than the average salary. Maybe some of that money, putting it into the market and being able to sell options. I'm not much of a day trader, but even if you have, a couple $100,000 saved and you can get some premium off that through selling options, that's a way to generate some income while you're looking for a new job from some of the money you have saved up. This is what The Verge reported today. So Hurricane Helene, is that how you say it? Helen? I don't know how they're saying the name yet, though. Barreled through a crucial chip mining area in North Carolina. So first of all, put in the chat if you were affected by the hurricane this weekend. If you were in Georgia or Florida or any other North Carolina. And let me know if you actually got, if it was actually bad. I saw some videos over the week that were pretty aggressive. But let's read a little bit through this. So the devastation also reached the small town of Spruce Pine, which is home to the purest quartz on Earth. Spruce Pine's high-quality quartz is an essential ingredient in the chip-making process as its only naturally occurring source of the ultra-pure mineral. The quartz mined from this area is used as a crucible to melt polysilicon, which is then used to produce silicon wafers, the base of a semiconductor. Interesting. Even though it's possible to produce pure silicon from the quartz found in abundance elsewhere in the world, it also takes a considerable amount of time and resources to do so. Hurricane, how do you say it? Helene dumped more than 2 feet of rain on Spruce Pine, with several reports on X showing extreme damage and flooding that has made roadways inaccessible while many people in the area are without power. So that's pretty much the article right there. I don't know how big of a deal this is for the semiconductor names. Maybe this is the reason semiconductors are down. Apparently, the purest quartz is in this small mining town, and now it's flooded, which could delay the supply chains for a critical ingredient in the chip making process. Maybe not. I guess we'll see if that ends up being a big issue. That could be a reason why semis are down right now, but it also could just be something that is not that effective. Helene. Okay, that makes more sense. Thank you, Natalie, for sounding it up for me. Helene. There you go. We were talking about effective communication, and we can't even say this word. Helene. On Beneficial says, I was okay, but I was on the east coast of Florida. Different person says, lost power for 2 days. House is fine. Okay, so it seems like pretty much all of you guys in the chat are okay. No one was affected that aggressively towards this. Chris lives in Georgia. Chris was okay as well over the weekend. He didn't have to deal with too much. Again, some of the videos I saw over the weekend were pretty bad. But But it seems like most people, hopefully, in the chat are doing okay. Can't we make synthetic quartz? Don't we have stockpiles? That's a good question. I don't know. I really don't know. I would imagine this is not the end of the world for semiconductor names. But maybe that's Palantir, by the way, 3706. That could be a reason why semis are down. I don't think this is the reason why semis are down. I think semis are down because of China, and China is saying to not use NVIDIA chips, but maybe that is one reason for why it could be down. Amit, can we discuss Tesla delivery numbers forecast when you get a chance? I sent Gene Munster's tweet to your DM. Yeah, let me pull that up. So I just realized this morning that Tesla delivery numbers were coming out on Wednesday. And I think that's going to be really important for a variety of reasons. So let's take a look at the expectations here for Tesla. Big picture, he says this should be a heads Tesla wins, tails they don't lose number because delivery should return to growth. The street expects deliveries at 465,000, up 7% year over year. I'm looking for a slight miss at 452, up 4% year over year. My personal gut feeling is if we're above 450, the street's going to be okay. If we're below 450, I think the street's going to be upset. If we get to 465, I think the street's going to be ecstatic, even if that's their expectation, because Tesla actually meeting those expectations is not easy. But 450, I think, is what is a base level. If they make the numbers, investors will say it's a double positive. First, they would have increased growth down 9% in March to down 5% in June to up 7% in October. That's a fair point. Second, this increased growth comes despite Elon's increased political speak, which has turned off some buyers. This message is it would have been better, been even better if not for the political speak. Again, I think some people didn't buy Teslas because of his politics. I don't know if that's like the majority of people. If they miss the numbers, as long as deliveries grow year over year, long-term investors should be okay with the print for two reasons. First, it would still mark a return to delivery growth for the first time this year. Second, a large part of the miss would likely be attributed to Elon's political speak that should eventually step back, or the rate of increased political chatter should decline. I disagree with that, dude. If Tesla misses their numbers, I do not think it's because Elon's been speaking politically. I just don't believe that, dude. I'm sure there's some people that won't buy a Tesla because he supports Trump. I don't think that's the majority of people. Maybe I'm wrong, but I don't think that's the case. The company thinks they'll return to growth. The reason to expect growth is on the June earnings call. CFO Vaibhav Taneja says that the factors that improve growth from March to June should persist into the September quarter. This includes increased availability for more affordable vehicles, which should see more options unveil on October 10th. The funny thing about deliveries, bro, is like, do we even really care about, I know we care about them for top line revenue, but we had RBC on CNBC today give their Tesla deliveries preview, and deliveries matter for the numbers, but if the future we're going to doesn't care about deliveries, we care about rides, then do deliveries actually matter? Are they that relevant at the end of the day? I guess they're relevant now because we don't officially have autonomy, but once we get it, it's not going to be that big of a deal. And we know that that Tesla's struggling with EV sales. We know that hybrids are gaining momentum. We know that EVs are not as popular as they were in 2019, which is why I think they made the pivot ultimately to get into autonomy. But it seems like autonomy is where the market's going to really start putting their bets. Here's what RBC had to say as well today on Tesla.
Markets analyst Tom Narayan has a 224 target and a buy rating on Tesla. It's good to see you again. Tom, I just wonder if you think any of this goodwill around this month's delivery number is deserved right now.
We're also seeing it on a relative basis, which is, I think, how most auto investors look at versus what's happening in the rest of the industry. This Stellantis profit warrant comes on the back of 3 other profit warrants from European automakers in just the past couple of weeks. So I do think a lot of folks are looking for safety. Tesla, interestingly, it seems to be a place where they can get that.
Yeah, some of the EV numbers out of France and Germany for August were so horrible. Is there a share shift happening over there?
No, it's a complete market dynamic. You saw incentives get cut at the end of last year in Europe, especially in Germany. And also just pricing is just too high over there. You will get some relief in 2025, though. Remember, these OEMs have to make a very severe CO2 regulatory cliff, so that will come back. But definitely that softness in EVs is being felt very severely. We do think incentives will have to come back, especially in Germany. That should help a little bit in 2025.
I mean, deliveries this week, but then the robo-taxi day the week after. And I do wonder how much of this is optimism and excitement over that and starting to price in what that might look like.
Yeah, that's fair, right? And the stock has run quite a bit. It's it's run, past my price target as well, notably. So sure, folks are looking at optimistically on robotaxi and what that could mean. But that said, in the backdrop of what's happening in overall autos, I still think it makes sense to still be constructive there. And recall what's happening in Europe, for example. Next year, that regulatory cliff, guess who these OEMs in Europe are going to be buying credits from? Tesla. So I think a lot of folks look past where the price is, the share price is, and looking more towards sentiment and the narrative. The narrative is autonomy. Sentiment is numbers beating. These regulatory credits are going to be pretty big. Then you have energy storage. Deliveries look like they're going to be fine. So on a sentiment basis, which is, I think, how this stock trades, I acknowledge it could be a sell the news type event, robotaxi, but the day. But I do think there's enough inertia now, given how the rest of autos is trading, that it could still catch some support.
Is a return to the highs on Tesla anywhere in your modeling right now?
Yeah, I mean, look, my modeling is very conservative. I don't include any optimists, which is, by the way, coming up a lot in questions. Folks are starting.
By the way, he's not alone. No one on the street talks about optimists. So on 1010, if they show anything that is reasonable enough for someone like Tom Narayan from RBC to say, hey, maybe I should think about optimists, that is something I don't think people are prepared for. Could it be a sell the news? Yes. Could it also be a holy crap, there's a real revenue stream that's about to come up in 2 years that we need to factor into our models and then apply a DCF to and kind of think of our price targets? I think that's also possible. And if Tesla shows off something with Optimus, maybe that's where we get some more momentum.
To look at that, my robotaxi numbers, I think, are quite conservative. 400 billion of value. I think this could expand autos well beyond the 2.7 trillion level. So the upside is significantly higher than where my price target is. And definitely you could make a case, obviously, for where the stock is trading. But again, I don't think folks are doing the math on DCFs on this name, right? They're looking at catalysts near term, and there are several. And I do think folks will continue to be excited on the back of the robotaxi event.
Tom, appreciate it. We'll see what we get on.
I mean, let's see. Let's see. But I do think there is going to be some momentum on this event. And if they show some robot stuff, that's going to be exciting. Palantir is green, folks. It's up almost 1%. The stock does not go down. 37.11 on Palantir, up 0.73%. Dude, people like the stock. People like the stock. 37.11 right now on Palantir. S&P 500 as well. We got about 30 minutes until we close out September. S&P at 570. Looks like we're going to be up about 2% for the month. Robinhood 23.41. Robinhood for the month. Let me check their monthlies. I think Robinhood's up like 7% for the month or something. For the month, 18%. A little bit more. Robinhood, if it closes in this range, about 18% for the month. Not too bad. Rocket Lab, one of the best months, up like 50%. Apple 231 is still, I woke up this morning and I just could not believe we were in the 230s, but that's primarily because of China. So Apple gaining some momentum there at 231. Looks like it's going to close above 230. Nvidia 120, Tesla 258. Tesla also a hell of a month for Tesla. HIMS 1836. The cruise lines today still couldn't catch a bid. CCL down about 1.54%. Again, amazing quarter. I think if you're long on this, the quarter looks like it's shaping up to support the long-term thesis, but maybe not the best day to do the actual report. And that's why it's not getting too much momentum. Qs are down about a third. Where's the Mag 7? Everything's up in the Mag 7 except NVIDIA, Amazon, Microsoft, and Tesla. Microsoft's barely down. Apple's up. Meta's up. And then Google is up on the day as well. It's clearly because Karp is a good storyteller. I'm sure it has nothing to do with the underlying business. Again, like I think obviously the business is reaccelerating, but Karp's storytelling abilities are just incredible. And again, I don't even think he's trying, right? Like he's not like trying to paint some story. He's just like, when he talks, people listen. There's a certain energy. And I've been saying this for years, dude. When he talks, you listen. And that matters. Like it really, especially if you've invested in a company with a CEO that can't get people to actually care, forget buy the stock, but like legit care, like get through a 5-minute clip. It really matters when you have a CEO that can get anyone to care, whether they're invested or not, right? Whether they love him or hate him, they want to listen. That's a special quality. It's a very special quality. And I think that's what Karp has. Don't forget the port shut down at midnight. Yeah, we talked about the port stuff on the market open. That's going to be bad. I would hope in the next coming weeks or coming days, not weeks, that is resolved. October 1st, so 12 a.m. tonight, it'll officially start this shutdown thing. And $3.8 billion a day is going to be under jeopardy of not being done in terms of transactions for imports. I hope it doesn't last more than a week, dude. If this thing lasts more than a week, we're gonna have some issues. But I think we can deal with a couple days, call it 5 days most dealing with it. But then after that, we got to move on from it. So hopefully we get some momentum. Today marks Alex's Chris 1 year as CEO of PayPal. How do you think he's done? Well, I mean, I think Alex Chris has executed really well, to be honest. And that's not just because the stock has gone up. I mean, like PayPal itself has done a pretty damn good job just launching new stuff. Over the past year, stock's up 32%, which is amazing. I think he inherited a pretty crappy situation. I mean, when he came into PayPal, they were literally shutting down your account based on like the reason for the money you were sending, or like, you know, or like their terms of service had this new clause that you had to sign up for a certain restriction on how you send money. Like it was a lot of weird political stuff going on, and he took over that and he became, you know, the guy who had to lead that ship. Past 6 months up 20%, year to date up 26%, over the past year 32%. I think he's done a great job. Also, they launched a lot of innovative stuff in January. Now we will feel the extent of those products probably towards the end of the year in their numbers. But he's definitely launched new initiatives. And as a CEO, that's all you can ask for, is like try to put new stuff out into the market and see what happens. Also, still 450 million users. Transaction margins are going up. The average number of transactions is up like 13%. I think it's like 57 per account. Like, it's not like he's had a bad first year. It's just the stock was stuck for a good 7 out of those first 12 months. And, you know, now the stock is getting a little bit more momentum as well. Yeah, right there from Paul. If you don't offer PayPal, I'm not buying from your store. There you go. PayPal is, you could say PayPal is a dinosaur. People still use the dinosaur, even if you say it's a dinosaur. And that's why I think they're continuing to maintain their momentum. Also, their fair value is closer to like 95 to 125. And like, still, it is deeply undervalued. It's just the opportunity cost of holding it has been bad, but it's starting to get a lot better as the stock maintains momentum. Look at Palantir at 37.13 on the day. Who's buying it right here at 37.13? I don't know. Someone's buying it. There's some people in the world that are buying it. Volume is 30 million shares. It's resilient, bro. It is pretty damn resilient. Every time to purchase an Uber, you are using PayPal. That's true. You got Braintree. I always forget about Braintree. That's their back-end infrastructure for B2B payments. So that is also helping PayPal as well. And that's growing 30% every year, which is incredible. So that's a good thing. What else? Okay, I think we have Ryan Detrick on CNBC. Let's see if he's... Yeah, here we go. All right, let's get him. This is the guy that makes all the fancy charts that says if XYZ happened on September 4th, then XYZ will happen on October 4th. Like, he's the guy who comes up with these charts. Let's get his take on what's going on right now as we end out September.
Quickly, obviously, thoughts about everyone impacted by the hurricane. So let's just look at what's happened so far this year. This year, Scott, right now is like the best start to a year for the S&P 500 since 1997. Now you think to yourself, okay, well, maybe we're stretched, right? Up 10 of 11 months. That's getting up there. Maybe October could have some volatility, but the reality is this. I've come on with you for a long time now saying this economy is stronger than people think. Earnings growth continues to improve. The rotation trade into many groups continues. Yes, we are stretched near term. October is the worst month. I know I sent something to you last point here on October. You know, when you're up 20% for the year, Scott, October actually usually doesn't do that well. Okay, it is what it is. You're up a lot. Down 7 out of 9 times, down about 3% on average. So I think the key thing is if we get some volatility this October, before an election, in an election year, October is usually not that great to begin with, would be perfectly normal. With the underpinnings that have got us to 42 all-time highs this year are still in play, and we still think, you know, once we get through this, we're still going to be a good deal higher before the end of the year.
I know those historical things, I feel like they mean nothing, right? We came into September, everybody's like, it's a historically bad month, worst month of the year for stocks. And here we are having this conversation.
No, I can't disagree. Obviously, that caught a lot of people with the September. We had that volatility to start the month. I was in New York with you 2 months ago. We had all that volatility around the yen carry trade.
Yeah,
right?
that was
and then
August 5th. That was like almost 2 months ago.
No, exactly. But just remember how worried and feared, how scared everyone got. And now here we are, obviously well off that. But you're right. I mean, that's the seasonals. Let's look at what's going on just last week. I mean, just last week we got those revisions to GDP. GDP in the U.S. last 4 years was revised well up over 1%, real GDP. Just to put that in context, Germany grew 0.3% for the past 5 years of their GDP. Incomes have really gone higher. The savings rate.
Bro, Germany growing 0.03% over the past 5 years is wild. Like, it just goes to show you America's not perfect, but at least we're growing. At least like the economy's set up to like have some growth, which is why all the American companies are getting all the investor capital across the world.
Which everyone said was bearish because saving rate was 2.9%, was revised higher to 4.9%. Okay, the reality is, yeah, things aren't perfect, but the underlying pinnings are still there. It's still a strong economy, and there's record earnings. I mean, forward S&P 500 earnings growth is an all-time high, 267. That's the most we've ever seen. You know, we can talk about worries too, but I've been bullish for a while, Scott. And we still think this is the way it's going.
There's reason to be optimistic. I mean, the Fed chair himself was just talking how good the economy is. I mean, I know, you know, people want to knock this about it or that about it, but the overall economy is pretty solid, as he said. Labor market, though, softening a bit, still pretty strong. But that leads to my next question. Are you prepared for smaller rate cuts going forward? Because that seems to be the table that the Fed chair himself has set.
Mm-hmm. Yeah, we think that's possible. I mean, a couple 25 basis point cuts is fine. I don't think another 50. Honestly, do another 50, it might mean the economy's kind of weakening even more, and we don't see that, right? So that's something to think about. Just one other thing, you tied a lot good talk about rate cuts earlier. We took a look, Scott, when the Fed cuts within 2% of all-time high. It's actually happened 20 times. It's not as rare as you think. Back in 2019, we saw it. This is one of those, it is what it is. Let's just not ignore it. 1 year later, S&P's higher 20 times of almost 14% on average. Lots of other stuff to look at. But the reality is, again, the Fed is now cutting. The Fed is now more dovish. That is a tailwind when you have the reality of the economy strong. Last comment on this. I mean, the Fed's cutting for a couple of reasons. Really, we think it's because inflation's last year's problem. I've been saying that for a while now. Just on Friday, the PCE data said, again, inflation's not really a problem. We don't need interest rates over 5%. That's why cuts are coming.
What about the broadening? We've had a lot of broadening over, you know, this quarter is going to be remembered as finally when you had the equal weight outpace the market cap weight. Is that something that continues or no?
No, we think it does. I mean, I've come on, you know, we've said a while, we're more neutral technology. 3 months ago, people thought we were crazy to say that. We've thought this broadening out is going to come. It's going to start when the Fed finally starts to cut. And I know small caps are a dirty word a lot of times. Small caps historically start to outperform when the Fed actually cuts. But mid caps have been our largest overweight all year. Mid caps quietly have done really well. So with the cutting in play, we think this broadening out theme that we've been talking about all year is alive and well. And we do think it's going to last more than just a quarter or two. This might have a couple years to it, Scott. I mean, the last comment here, small caps are open to large, historically cheap since 1999. That kicked off a 12-year period of small caps outperforming large caps. Not saying that's going to happen again. We're just saying there are parts of this market that are cheap, and those are some areas you probably want to look into.
All right, we'll leave it there. Ryan, appreciate it very much. Ryan Detrick,
thank you.
Carson Group. Up next, Fed Chair Powell saying.
I agree with a lot of what he said. At the end of the day, we have a pretty strong macro landscape. S&P 500, 571 right now. And, you know, if we do 25 and 25, I don't think that's crazy. I think 50 is still something that I think the market would like to see. Where is the futures right now on probabilities? 25 and 25, if the economy holds up, is also not horrible. But obviously, I do think that if the labor market starts to weaken a bit more aggressively, which so far projections aren't showing that, we should get 50. So right now, Mark is expecting a 67% chance that we get 25 bips and a 32% chance we get 50 bips. So right now the market is on the side of 25. Looks like that's what the Fed probably is going to do unless the labor market data ends up being really bad on Friday. If the labor market data is good, we get another 25. I still think that's fine. And to get another 25 after, then that's 100 for the rest of the year. Does anyone know the name of the small cap ETF that only has small cap companies that are profitable? Does anyone know the name of that company or the name of that ETF? I want to pull it up. Small cap profitable ETF. What is it called, dude? I feel like I'm forgetting the name of it. It's like IW. It's not IWM. It's IW something or IWJ, IJW, something like that. Because we can narrow down the small caps to only the profitable ones. IWO. Yeah, I think that's the one. IWO. Thank you for that. Yes, this is the one. This is the one, right? Or no, is it IK? Is it IJR? I actually think it's IJR. Yeah, is it? I'm pretty sure it's IJR. IJR ETF. Yes, I believe it's IJR. Correct. Okay, so IJR is up 8% year to date. If I'm not wrong, I'll double check on this, but IJR is up 8% year to date. These are small caps that are profitable only. IWM is up 10% year to date. So one thing to look into if you are bullish small cap and bullish sector rotation from large caps into small caps, IJR might be a better version of getting exposure to that versus IWM. Let me see what companies are in IJR. Simply because of the fact that you're at least giving yourself companies that, or an ETF that's not filled with a ton of random companies that are just not that profitable. The top holdings in this are ATI, Carpenter, Meritage Homes, Lumen Technologies, a lot of companies I don't know, but a ton of different small caps. Yeah, I mean, look at these, dude. Some of these names, some of these small caps are up 58% year to date. Look at that. Mueller Industries. I don't know what that is. Carpenter Technology, this one. Dude, there's so many small caps. All of us, at least myself, have missed out on. This is 126% year to date. I don't know what any of these stocks are, but this is the ETF that I think probably deserves a little bit more respect than IWM, just because they're handpicking small caps, but small caps that are actually profitable, which is good. You know, you want small caps that are doing SPX Technologies. I don't know what that is. 158. That's up 50% year to date. IJR, small cap 600 ETF. That is the ticker that I'm looking at. Over the past 5 years, it's up 50%. And over the past year, it's up 23%. Past year to date, it's up 8.6%. So IJR is one to look at. Smile Direct Club is now. You know, I own some Smile Direct Club. I think I took a loss on this. It was probably like a couple $100, but I owned that sucker back in 2020. It was supposed to be the new way for like dentists or whatever to it was the dumbest. Dude, 2020 was so stupid. It was so dumb with some of these companies going public. But yeah, I definitely had a little bit of Smile Direct Club. Anyway, I brought up IJR just to for folks to look at an ETF to get exposure to small caps if you're bullish on small caps, but also to get some profitable small caps so you don't have to deal with some of the junk that's in the IWM, because there is a lot of stuff that's just like unprofitable and dead. But in general, both ETFs, if we do see a real sector rotation, should do well. Look at the S&P. We got 15 minutes or 18 minutes until the close, folks. We're going green. We are going green. It's a slight green, but we're pushing green into the close, which is really nice to see. If we close green for September in the 571s, I think that would be absolutely incredible. And it would be nice to kind of see some momentum into that green. We got Robinhood right here, 23.42, down about 2% on the day. Q's down about 20 bips. They've recovered a little bit. S&P going green. China went red. Alibaba just went red. And then FXI just went red. By the way, FXI down 1.27%. Look at NEO. NEO was up 20%. Now NEO's barely up 3% today. So NEO gave back all of its China stimulus gains, at least for today. It's still up nicely from last week, but at least today. And then JD, this thing was up 8%. This thing today was at 43. Now it's at 40. It's up 0.48%. And then Baidu was at 111. Now it's at 104. Now it's red. So I don't know if that's just people taking profits or if that's like just investors not like believing in some of the pump that we got from China. But we did go red for the day on China right now. Have you done some more DD on Rocket Lab? No, not really. Not really, to be honest. I've not done enough. I'm trying to understand Neutron a bit more, so I'm trying to get a better perspective on that to see what the potential is. I think doing Neutron DD, which hopefully over the next week I'll be able to get some good stuff in, that's better than doing DD on the financials. Because if Neutron's a winner, which is what I keep hearing from the Rocket Lab community, then I think the financials, where you buy it at $5, $6, $7, $8, $9. If this thing is like a $40, $50 stock in the next 5-10 years, then it really doesn't matter. But Neutron's got to be the thing that like takes them there. At least that's what I'm being told. So that's where I'm going to do the DD on. I'm not that excited to buy it at 960. I mean, it's up 50% in a month, dude. I kind of feel like that's just you're buying the top a little bit. Now, look, I could be wrong here. This thing could squeeze up to 20 or whatever, but I don't know. It does feel a little aggressive buying after a 50% move. And, I was even talking to Matt about it. He said you could expect some pullbacks. And so I would imagine, if we get some pullbacks, we'll see if there's a better entry price. Now, Palantir is one that we expect some pullbacks on, and we have not got that. Palantir 37.15 up almost 1% on the day. This is one that we really have not seen any meaningful pullbacks on. Maybe Rocket Lab ends up acting like this one as well. Have you seen IONQ? Yeah, I've heard of this one. They got some deal on Friday, right? That's one that one did well. They're down 10% today. I don't know why they're down 10%, but on Friday they were up. Again, small cap companies, not profitable. Got to be a little nervous about them. Where's Enovix? Enovix right here, down 3%. What's the other one? Oklo. That one is down. Wow, that one's down 10% today. Interesting. Where's Poet? Where's that stock you guys liked last week? That one is basically flat on the day, down about 0.5%. Yeah, I mean, we'll see what October holds. October's going to be very interesting for a lot of these companies, but if we can end out September nicely. Wow, look at the S&P, 572. Look at that, going green into the close, baby. Going green into the close. Why would you buy SoFi but not Rocket Lab? So remember, I bought options on SoFi based on an asymmetric opportunity that if SoFi gets anywhere near 20, I 14x my money, 10x my money. And SoFi's in a downtrend that it hasn't broken for 3 years. Rocket Lab has definitively broken its downtrend. Now it needs to maintain this like $8 to $9 range to like kind of say it's out of the downtrend, but it's definitely broken through it. And Rocket Lab is up 50%, whereas SoFi still, is it up for the year? SoFi stock. SoFi is still down for the year by 18%. I don't know if SoFi is the better buy than Rocket Lab. There could be a fundamental reason Rocket Lab is the better buy. I just think the options are way more asymmetric. I did look at the options for Rocket Lab. There's not given the move now, there's just not an asymmetric opportunity. There was like 2 weeks ago, but I didn't pull the trigger at that time. So that is my reasoning for it. And that'll be my SoFi exposure if it ends up breaking out from this downtrend over the next year. 35.75 was the best pullback so far in Palantir. Yeah, pretty much. 35.75. So we are officially starting the market close, folks. If you are joining, we've been live for the past 2 hours talking about Jerome Powell. He gave a live speech today, said nothing really that interesting, but he did say that we're going to look at the data. I guess the most you can pull out of what JPow said is we are going to be data dependent on cutting rates given how the labor market performs. He did say you shouldn't expect an aggressive move on rate cuts just because we did 50 bips last time, which I think is when the market really kind of went down. But all he was saying was, hey, if the labor market's good, we don't need to be that aggressive because we were already that aggressive, but we're still going to cut. There is no doubt in my mind we're going to get another cut unless we had like 300,000 jobs, which is just not happening likely. So, and if that is happening, that's really good news because 300,000 jobs, that means plenty of people have money. They're going to be spending money. That in and of itself is a catalyst for stocks, even if we don't get rate cuts. So either way, I think it can help, but we're probably going to get 25 bips. Fed futures are pricing 25 bips. JPow basically pseudo confirmed that contingent on the unemployment data we're going to get on Friday. And that unemployment report on Friday will let us know where the rates are for unemployment and how many jobs we're adding. And that'll probably determine if we get 25 or 50 cut or 50 bips going into the November meeting. Palantir right here, 37.20. Wow, look at that. Look at that momentum into the close. Oracle up about 0.5% right now. S&P 572, nice. Going up into the close. Apple 231. Nvidia still down, but recovering a little bit. There's a green candle right there on Nvidia. Last 12 minutes of September, people are buying some of the dip. What do you guys think in the chat? October is going to be green or red? What do you think? Green or red comments in the chat. October is green or October is red? All of us thought September would be red, and in about 12 minutes, it'll likely end green. I don't know, bro. I don't know. I don't know if October has to be red. I feel like there's a world in which, like, if there's no real fundamental catalyst to take it down, which, outside of just random volatility going into the election, I don't know what the kind of core fundamental catalyst is, then maybe it maintains momentum. Palantir right here, 37.19 on the day. All right, most of you are saying green. It is going to be earnings season right near the end of October. We get tech, and at the midpoint of October, we get financials. And as long as financials do okay, and then, the Mag 7, dude, my only fear for the Mag 7 is that they are spending so much on CapEx with almost zero ROI in the short term, which is what the street's going to be upset about. Or worse than that, they stop spending on CapEx, and then the street's like, oh my God, this whole AI revolution thing is fake because look, Meta's not spending as much as they were spending before. The only way to resolve that kind of double bind of a scenario that they're in, which I think is a very real double bind, we forget that the day they actually report, this is like the internal thing that the market is trying to grapple with. If a company like Meta or Microsoft can show the CapEx spend that they're spending, which I don't think is going to decrease for any of them, and then paint a picture, again, tell a story that this CapEx spend is specifically delivering results on X, Y, and Z. Even if they can't say, hey, our financials are up 30% because we spent $300 billion in GPUs. But they can kind of say, which credit to Zucks, he's been saying, hey, our ads are becoming way more efficient because of these GPUs. If he can kind of point to stuff like that, that's where I think the market's going to be like, okay, all right. Palantir, by the way, 37.23. That the market's going to be like, you know what? It's okay. It's all right that you're spending this much money. We're going to allow it. Now, if Microsoft misses their cloud numbers and Copilot's not really growing, and you get into all the other random things that aren't showing that much growth, but they're still spending a crap ton on AI, Satya Nadella is going to have to convince the street that, believe me, bro, right? Just believe me. Believe us, in the next couple of quarters, you'll see the ROI. Whereas, and that's where I think the market can get scared. Whereas if they show some ROI, just something tangible that the market can hold on to, that's where I think big tech earnings does really well, because the AI narrative is intact. The ROI is there, is justified, and then the CapEx is reasonable. But I think all 7 of the companies have to figure it out. Tesla has already kind of got to figure it out with FSD. They just have to roll that out. They don't really have to justify it. Google, they're going to have to figure out how to explain search advertising and potentially the search monopoly decreasing a bit. Microsoft's going to have to explain cloud. Amazon has to explain how that helps advertising, particularly because they missed by 20 million last quarter. I know 20 million is a small amount, but still the street was not happy about that. Or I think it was 200 million. Yeah, the street wanted 13 billion. They came in at 12.8. So it would be nice for them to meet on advertising. And then e-commerce, LLM functionality for search, that would be good. Obviously, AWS Cloud, that would be good. For Meta, it's advertising. And for Apple, they got to sell more phones. That's it. They got to sell more phones. If Apple sells more phones, Microsoft sells more cloud, AWS sells more ads, Meta sells more ads, Google explains how their ad monopoly is not going to die out. Tesla kind of explains the FSD rollout coming soon. And then NVIDIA just benefits from all 6 of those companies paying them for doing all of that stuff. We're going to have a good Q3. We should have a really good Q3. I think that's how it plays out. And then if Palantir comes out and delivers 30 to 35% growth, we're going to the freaking moon. It's just that simple. If Palantir comes out and says we're going 35%, I think it's over, bro. It is this is already the darling of Wall Street right now. And it used to be the ugly stepchild. Things have changed. And if they can bring up the growth, if they can put up the growth momentum going into Q3, I legit think it's game over, bro. I think Palantir becomes the winner, because if they do 35% growth, what do you think is going to happen the next quarter? The Qs are going green. Wow, S&P up 1/3%. Let's go, baby. 7 minutes until the market closes. If Palantir goes 35% in Q3, what do you think is happening in Q4? They're not going to grow less than 35%. If they grow 40% in Q3, which I don't think is going to happen, but imagine it does. They're not growing less than, once they put their foot in the ground and have the NVIDIA May 2023 quarter, or sorry, March 2023, that's when everything changed for NVIDIA. That's when NVIDIA went up $100 literally in 5 minutes. That's when the world was like, oh, NVIDIA's here. I think Palantir is maybe a couple quarters away from that, but once that quarter happens, it's game over. And it's going to be really exciting to see how that happens. But again, the reason Palantir needs to do that is because they can show that these LLMs have a use case in the enterprise. And Microsoft can win their narrative, Amazon can win their narrative, Meta can win their narrative. If Palantir wins the enterprise narrative, that's a big narrative to win. And I think the street's going to reward them if they can continue to do that. Do you think we're gonna have a similar result to Q1? Well, so if we grow at sub 30%, I think there's a world in which Palantir can crash 20%. I think there's a world where that happens because the valuation's up there. And at this point, we really need to show the numbers. Now, granted, that would be a dip that everyone would buy, including myself, right? So I don't know how bad of a thing that is. Number two, if that's a dip everyone's going to buy, is that really going to become a dip? Right? Like, who's really going to dump their shares on 27.5% growth versus 30% growth? If we get to 30, though, I think it's going to be exciting. Like, I like the S&P 500, inclusion that created all these institutional investors. Palantir right here, 37.25. Are they really going to dump their shares because Palantir is going at 26.5 or 27.5 or 28.5 versus 30.35%? No. And if they do, then I would gladly take those shares because that's stupid, right? And I think they know that's stupid. And so they're not going to dump based on that. So, I mean, I don't know, dude. What is the reason for why it dumps? Like, it would have to have a horrible earnings. And they already guided for $700 million in revenue, which is 25% growth. S&P 500 up 0.4%. We might close up 0.5%, which means if they're going to guide at least 25%, to beat that is not that hard, especially because they beat the previous guide by 5%. They guided for 22%. We came in at 27% in Q3 or Q2. So, I mean, like, I think Q3 is going to be good. And as long as the macro is good, I think Q3 is going to be good for Palantir. Now, again, that doesn't mean jump in and buy it at 37 because I'm not a psychic. I don't know what can happen. I'm just presenting the reason, look at this, 37.30, for why this stock continues to maintain its premium. And it doesn't have to make sense. I get it. But it is what it is. And it's what's happening right now. A lot of people, thank you for everyone who watched the Chris Camillo podcast on the channel. There were some people that felt that it was all full of shit and him not looking at numbers is all BS. And I get that perspective. But I also do think there is some validity into just looking at a company's thesis on the narrative of the momentum they have outside of the financials and being able to make an investment just based on that alone. And that's what Chris has done his whole life. And that's why he's been pretty successful. It doesn't work all the time. And he talked about some of his losses as well in that podcast. But Palantir might end up getting into that narrative. We just got to see what Q3 earnings looks like. China's down 1.29%. We got 4 minutes left into the close. Oracle's up almost 1%. Wow. Oracle 170. Robinhood 23.44, down about 2%. S&P 574. Wow. Talk about buying into the close of September. Goodness gracious, bro. This thing was 568 an hour ago. Now we're at 574. I mean, just incredible momentum going into the close. September is going to be a month that ends for the S&P. It's going to be one of those months that we look back on in history. We're going to end about 3% up for the month. We're going to end up about 3% for the month. Wow. Just incredible, dude. This is absolutely incredible. Bayra says they're setting up to dump hard in October. Maybe. One of the banks came out today, and the bank was like, we think October is going to be more of a treat than a trick. I thought that was very cute. If I was the head equity research writer, I'd be proud of myself for writing that title. But maybe it's more of a treat than a trick. Maybe it's more than a treat. Maybe it's more of a treat than a trick. And October is actually going to be pretty nice. Bitcoin getting some momentum, but nothing too much. The Qs just went crazy. S&P is up 0.5% right now into the close. Literally, this gain that you're seeing right now on the screen, this came in the past 10 minutes. Like literally in the past 10 minutes. It was not here the majority of the day. Everything's green except Amazon and Nvidia, but Nvidia is like 2 cents away from going green. Amazon's still down about 1%. Tesla, look at Tesla, 261. Oh, I love this by David. Pumpkin. I like it. I like that one. That's a good one. We got Tesla at 261, Microsoft at 430, Apple at 232. Meta is back at close to all-time highs. Remember, Meta's all-time high was 576, I think. Or 577 on the Meta event last week. Google at 167, Nvidia at 121, 261 on Tesla. S&P 500 at 574. Not bad, man. Not bad at all. It would be funny if October collapses tomorrow, but it would also be really funny if October just goes higher. And, as we get into October, we start to continue to see more momentum. Again, we have CPI that's going to be good. We have jobs data that I believe is going to be good. We got, the election to get through. That's the election, but still, we got a ton of macro things going in the right way. And then if Q3 earnings are good, we got a lot of money on the sidelines that is probably going to want to. I mean, forget money markets, dude. Robinhood themselves have $20 billion that's collecting 4.5% in APY. That money might start come out to play, which is good for Robinhood's transaction revenues. But like, there's so many different brokerages and high yield savings accounts that have this money that's just locked in there that might start getting ready to get into equities as the macro landscape continues to improve. So let's see how this ends up playing out. All right, folks, we got 10 seconds until we end out September, one of the most volatile months of 2024. It looks like we are going to go green September 30th, 4 p.m. The stock market is now closed. September is now closed for trading as well. All right, here we go. We have officially ended the month of September. Let's see how the market did. September in the past month for the S&P 500 is up 2.57%. 2.57% on the S&P. For Palantir in the past month, 19.14% on Palantir Technologies, ticker symbol PLTR. If you didn't know the ticker symbol, Robinhood ends out the month up 18.22% at $23.42 as well. Let's take a look at Tesla. Tesla after hours, or Tesla for the month. What do we have on Tesla? Tesla for the month ends out 22%, 261.6 on Tesla. 22% over the past month. Again, all of this for the month of September. Let's go to NVIDIA. What do we have for NVIDIA? NVIDIA for the month of September has officially closed out up 7%, which is not bad considering where it was at the end of August. 121.44 ends up about 7.4% on the month. The Qs have ended for the month of September at 488. They are up 3.65%. Not bad. Not bad at all. NVIDIA did close green. Apple's had a nice little run throughout this month with the idea that the super cycle for the upgrades are coming. Apple for the past month is up 3%. Again, not bad on a $3 trillion company. Year to date, Apple is up 24%. Meta also an incredible month for Meta. Meta basically ending right near all-time highs. Meta closes out the month of September up 10%. Year to date, 63% on Meta. 572 as Meta closes out the month, which is not too bad. Not bad, dude. It's been a good month. It's been a relatively decent month. Now we get into October, and we see what happens into October. NVIDIA just closing green right at the bell. S&P 500, 573.95 on the bell, up 0.42%. Again, that 0.42% came in quite literally from like 3:45 to 4 p.m. Because the rest of the day was pretty stagnant. Palantir right here at 37.20. Rocket Lab was up about 50% this month. Rocket Lab closes at 9.73. Not bad. The Chinese stocks all did very well, except towards the end of the day where they sold off. But still for the month, they've done incredible. SoFi 786 still was down about 1.13% on the day. Coinbase had a good month because Bitcoin recovered, but down about 6.83%. CrowdStrike also not a horrible month at 280. Amazon 186. So that recovered from around 150. Google at 165. Had a tough month with the DOJ stuff, but still stayed relatively stagnant. Google for the month, its actual month-to-date gain was 2.9%, which again is not too bad for a company like Google. MicroStrategy right here, big month for them, up about 0.24%, down about 4% on the day. And then you had Costco as well. Costco ended the day kind of flat, 886, but at one point it was 915 during the morning. Also had a good day with some decent earnings. Not a bad month. Not a bad month at all about September. So here's the question for the chat. What was your best move of September? Whether it was a buy or a sell. You guys already know my big move that I made. I took out $40,000 of the initial $50,000 I put into 2025 Robinhood options. Helped me sleep at night. Took that $40,000, kept some cash in the portfolio, and was still able to maintain some upside because I rolled those options into a new strike while capturing the initial cost that I put into those options. So that was my big move for September. Other than that, didn't do too much. But what was your best move / sell / buy in the month? Let's see what some people have to say. We do have Nike earnings tomorrow, and that's like the biggest one for the week. So Nike earnings tomorrow. We'll see what they have to say, and that'll be a big one after hours. A lot of you are saying Rocket Lab. All right, so a lot of you apparently bought Rocket Lab in September. Bitcoin as well had a decent September, which is not been too bad. Amit, what have been your disappointing stocks? So you guys know my biggest disappointment, and that's my biotech that I thought was going to cure cancer. It was ticker symbol PPBT. I don't even need to go into it. You can look at their history with reverse splits and all that stuff. That's always been my biggest loser. This year it's just been Hood and Palantir. That's my portfolio. So I mean, those two have had good years. It's been a good year. That's not going to happen every year, but Hood and Palantir have been good. Last year TFC did well. Google was not a loser for me. I made $1,000 on that, but Google I ended up selling probably a bit too early at 140 with the options. But if I held it till 190, that would have been a better sell. But outside of that, there haven't been a lot of crazy losers this year, but that's because the markets have done well this year, right? And so it's been a stock picking market. You've had to pick the right stocks, but if you pick some decent stocks and they did okay this year, then this year has been relatively good for most people. Hood, Upstart, Leaps, and Rocket Lab. Okay, not too bad. Doug says he closed some Google spreads today, caught the market mispricing for a 25% gain in a week. Not bad at all. I think Doug had some 280, 290 Jan 2026 Google spreads. Pretty aggressive out the money spreads, but not too bad getting 25% on those. Worst move was writing covered calls on Rocket Lab. Yeah, you might have to buy those back. You might have to take a little bit of a loss on those and buy those back. But again, is a 50% move sustainable on Rocket Lab? I don't know. If the shorts are really covering, then yeah, maybe it is sustainable and you might have to buy those out. If not, then maybe you'll get to roll out of them for a little bit of a credit. Thoughts on Bitcoin in October? Bitcoin moves with the NASDAQ, guys. If you look at a lot of charts with Bitcoin, it moves with the NASDAQ. So if tech goes up, Bitcoin will go up. If tech goes down, Bitcoin's going to go down. It's just that simple. So the market, particularly the NASDAQ, tech is what's going to control Bitcoin. And I hope tech goes up because that's great and that'll help Bitcoin. But more liquidity is opening up, which is bullish for Bitcoin. Now it's just a question of getting another set of rate cuts from the Fed to really open up more liquidity. And then I think Q4 for Bitcoin ends up being decent as well. October 30th is Hood earnings. Did they announce it? It's in October for the first time? Really? Did they do that? Yeah, wow. I like it. I like October. I like October over November. Right before Halloween. Wow. Oh, this is going to be a fun one, bro. This is going to be a fun one. Interesting they're doing it. Usually they do it the first week of November. Why do you guys think they changed it? I don't know why they changed. That's interesting. Maybe there's something around like market timing and they don't like doing it in November because I don't know. November is a weird month to do it in. Interesting. They've never done it in October. Maybe I'm reading too much into it, but there you go. October 30th. That means Palantir Q3 date should be coming out soon. Palantir usually does it first week of November as well. We should be getting the answers. The date soon. No news on Palantir yet. Let me check insider selling. We don't have any insider selling yet. Sometimes it takes a couple hours to update, so I'll let you guys know, but nothing yet for Palantir. By the way, Robinhood's insider selling. Let me check right now, but I've been surprised that insiders have not sold on Robinhood literally since September 9th. And the guy who sold was Beiju, who's one of the co-founders of the company, who's not currently involved in the day-to-day. He sold 139,000 shares. But outside of that, it's been relatively quiet for any selling in Robinhood. Maybe that's because they think they're doing well and they're going to sell at higher prices if we get there. So we'll see. But not too bad. Not too bad. So October 30th, we have our earnings. All right, let me see what other moves you guys made in the month of November. Hims was a good move. Palantir's 37.18. Those after-hour glitches that are really aggressive, don't pay attention to those because sometimes they're not real, especially if they're on Yahoo or Google Finance. So I would give it a couple minutes and usually refreshes. But Palantir down about 1 cent after hours, 37.18. 19 right now. Hey, Amit, sorry if you've mentioned this recently, but could you give your thoughts on Nike with its new CEO coming in? I don't like the new CEO because I don't think he's an outsider that's going to transform the company. He was used to work in the company in 2020. He did some really good stuff. So I don't really have an opinion on if I like him or if I like the move or if I hate the move. If I had to pick, I would say I don't like the move because I don't see this like as a Starbucks CEO coming from Chipotle trying to shake things up. I see it as a guy who is just replacing a guy who's boring and hopefully can bring more life. So I don't really know if he's going to do a good job or not. I would imagine that the Wall Street's giving him the benefit of the doubt, which is why the stock is up, but no real perspective until I listen to him speak and, get through a quarter of execution at Nike as well. Bought MicroStrategy. Okay. Not bad. That was a good move in September as well. They want to bump before election uncertainty. That's a good point. That's a good point. Doing earnings right before the election. The election is November 5th. That's actually a hell of a point. I think that's the answer. Why? Does anyone want to report a week after the election? Literally, does anyone want to report? Like, no matter who wins, I don't think anyone wants to report into a brand new administration. So, yeah, that could be an argument. That could definitely be an argument. A lot of you saying Palantir was your best play. I like it. I mean, Palantir up 20% for the month. Not too bad. What other stocks do we want to see the month to date? What other stocks do we want to see the month to date? We talked about, let me see, PayPal month to date. Let's see PayPal month to date. What's PayPal month to date? Up 8% in the past month. That's not horrible. That's not horrible either. Baba month to date has been incredible, dude. Baba month to date, 29%. Look at that. Ending out September. Not bad. Celsius, let's see. Celsius down 15%. So Celsius has been a loser this month. SoFi is up for the month, I think. SoFi for the month is up 5%, which is not horrible. SoFi is up for the month. MicroStrategy, yeah, MicroStrategy is at a hell of a move. MicroStrategy 110 to 160. 37%. Not bad. Not bad at all. Intel and Walmart. Let's see. Intel month to date. That's done better. Up 16%. September, man. September's not been too bad. Walmart up 5%. September has been a decent month, even though everyone thought it wasn't going to be, including myself. Even I thought it was going to, especially after September 6th, dude. After September 6th, everything went to shit. Everyone felt like, all right, here's the volatility, especially after an August recovery. And then remember, then Goldman Sachs had some conference, NVIDIA started speaking, Oracle at earnings, CPI came in at 2.5%. Like all this shit started piling up. And then September ended up being a month where the S&P 500 basically ends up 4% for the month. Well, this is from September 3rd, so that's a little inaccurate, but it's up about 3%. I think the more accurate is 2.5%. Let's call it 3%. Up 3% for the month is not bad. Up 3% for the month is not bad for the S&P 500. I mean, what do you think about Whirlpool with interest rates coming down? More people will be moving and buying new appliances. Also, as a sweet 7% divvy. I have not looked at this stock ever, to be honest. Whirlpool stock. I didn't even know they had a dividend. Year to date, this one's down 13%, 7% dividend, $5.5 billion market cap. I'll do a little DD on this. It's up 9% in the past month, so September has been good to them. Yeah, I think your two-sentence thesis actually makes some sense. Let me look into this one. I forgot those guys were public. That was a big company. Even if they're not like a big market cap company, Whirlpool's brand is pretty damn big across the entire world. They got kicked out of the S&P this year. Interesting. All right, we'll take a look at Whirlpool and see what's going on. Yeah, overall, September's been decent, man. September has been pretty decent, and we ended the month in a way that's not too bad. Joseph Carlson just made a video called Palantir stock is extremely expensive. Do you guys want to watch it? Do you guys want to close out the show by watching this? Is he talking about it for 37 minutes? No, he talks about it for 16 minutes. Do you guys want to react to Joseph talking about it for 16 minutes? To be fair to Joseph, I like him. He's never liked Palantir, and he's probably annoyed that this thing is trading at fucking $85 billion in market cap. Dude, Joseph is he was not a fan of Palantir when it was trading at 20 billion market cap. I remember I had him on the channel. I talked to him on the channel. He doesn't do a lot of interviews, but he came on my channel a couple years ago. It looks like he's a little bearish on Palantir. All right, let's watch that. Let's watch what he has to say. But overall, guys, an incredible September. Not bad. The Q's up about 3%, S&P up about 3%, Robinhood up 20%. You got individual tech stocks that have done very well. Palantir up 19%. I mean, just an incredible month for the broader equity markets. And Tesla also up, I think, about 10% this month. We're going to see how things play out towards the end of the year and in October. But it's been a hell of a month for a lot of these companies. And now it's just a question to see them execute. Robinhood right here, 23.46 after hours. Palantir is at 37.21 after hours, up another 0.03%. S&P 500 down a little bit after hours, but up 0.42% on the day. Okay, let's go to Joseph. Let's see what he has to say about Palantir and his thoughts. What compelled him to talk for 16 minutes about Palantir? Let's see. All right, here we go.
Now, we start off today with the main story, which is Palantir is now an extremely expensive stock. Whether it's overvalued is a different question, but it is very, very expensive. Now, I know anytime you say something like this for a very popular stock, one that there's a lot of social media, one that a lot of people have their money in, there's an immediate backlash. People immediately jump to the keyboard. They go down to the comment section in a fury full of anger and hatred towards anyone that criticizes their company. So before you do that, before you race to the comment section to leave a comment that Joseph doesn't know what he's talking about, Joseph is just coping because he missed Palantir, Joseph just doesn't like Alex Karp's hair. None of that is true. So just slow down a bit. None of that is true. I do like Alex Karp's hair. I think it's cool. He has great style. He's a very eccentric leader. I do think that Palantir is a great company. So it's not true that I have something against Palantir. In fact, I've been very positive about Palantir for a long period of time. So before you jump to judgment and start leaving angry comments, just slow down a bit. Wait until you at least watch this first segment. Then leave the angry comments afterwards. Now, like I said, Palantir is one of the most popular stocks amongst social media and retail investors. And this isn't something that I'm just saying because I kind of see it. It's also something that I'm saying because the data supports it. Over 50% of Palantir shares are owned by retail investors. A minority is owned by institutional investors, meaning that it's a lot of individuals buying this company. A lot of individuals, a lot of small funds. It's not major institutions buying up Palantir, which I think is fine. That's a great thing to have individuals buying shares in a great company. So I don't see any problem with that. But it just shows that this is a really, really popular stock. There's no set answer in valuation. In fact, there's a number of ways to value a company. You can value a company through revenue multiples. You can value it through earnings per share. You can value it through free cash flow per share. You can value it through EBITDA or enterprise value. There's all sorts of ways to look at valuation of a company. And rather than focus on just one and try to nitpick one way of valuing Palantir, I want to look at it through multiple ways. We can illustrate the price of Palantir by looking at it through multiple lenses. Now, the first one we can look at is the free cash flow. This is one that I look at for every company. Basically, what Qualtrim shows here, this free cash flow yield, is the yield you're getting when you buy the stock. And this is very similar to the yield that you get from a bond. For example, if you look at a stock and it has a 4% free cash flow yield, that means that if you invest $100, based on their last 12 months of cash flows, they can pay you $4 back in a calendar year. So you invest $100, you get $4 back per year. Now, hopefully they grow that amount year over year. Bonds can't do that. They just pay you the same amount. Hopefully stocks will grow and they'll pay you $4 and $5 and $6 back per year. But this is the current yield. $100 invested, getting back $4 per year means a 4% yield. Palantir right now, not factoring in stock-based comp, not factoring in dilution, which is a whole other thing we could factor in, but even leaving that out, has a 0.81% free cash flow yield based on the trailing 12 months. Again, if we look at this and we look at the free cash flow, Palantir generated $700 million of free cash flow. That's a lot of free cash flow, but unfortunately, the market cap is $82 billion. The way you look at the yield is you divide the amount that they generate in cash flows, that's the $700 million, divided by the $82 billion market cap. You move the decimals 2 places and you get that 0.85%. And that's how we get the free cash flow yield of 0.84%, a below 1% yield, which is important. If we look at Palantir from this lens, that means that based on the trailing cash flows, if we invested $100, we get back 84 cents per year based on a $100 investment. And that is rather low, even looking at Palantir compared to comparable companies. Now, I realize that Palantir is unlike most companies. It's an AI company. It's led by a great leader. It has a great story. Palantir is awesome, but there's also a lot of other great companies, a lot of other great similar software companies. And if we compare Palantir to any of them, you may notice a difference here. For example, we look at another company, CrowdStrike. This is one that's just incredible. The growth is monumental. It is growing lockstep every single quarter, even after their failed software update where they had problems. You can take a look at the revenue. It looks like it's fabricated, but this is real. This is all recurring subscription revenue. So this is virtually the best type of revenue you can get. It's profitable subscription revenue, fast-growing cash flows. If we look at the free cash flow, the customer growth, all of it is growing lockstep, more predictable, more reliable than most software companies. And the free cash flow is at $1.1 billion. Again, growing every single quarter of the year lockstep. So this is a fantastic company. And if we look at the free cash flow yield, it is double Palantir's. As expensive as CrowdStrike is, this company's still at double the yield of Palantir's. So Palantir is far more expensive on a free cash flow basis than CrowdStrike. But we can look at other companies here. Again, Palantir is at a 0.84% yield.
You guys really want me to increase his voice? I mean, increase the speed? Dude, I never increase speed. I'll do it for you guys, but I don't usually increase speed. So we'll do what, 1.5? Playback. See, I don't even know how to navigate. I never increase the speed. All right, we'll do 1.5. Okay. So we'll do that.
ServiceNow is at 1.67. It's over double. We have Palo Alto Network, another great fast-growing company, at a 2.81% yield. This is about 3 times what Palantir's is. Datadog at 1.74. We have Synopsys at 1.28. Even All
right, let me do 1.25, bro. Now I know how you guys feel listening to me, dude. That's ridiculous. This is too much. All right, here we go.
Microsoft, which I consider really expensive right now, has over double the free cash flow yield as Palantir. Viva Systems has 3 times the yield at 2.86. Adobe's at 2.83. Intuit's at 2.67. HubSpot's at 1.19. Oracle is at 2.44. Snowflake is at 2.23. Roper's at 3.47. Autodesk is at 1.81. Atlassian's at 3.41. Workday's at 3.34. SAP is at 2.5. And Salesforce has the highest free cash flow yield, meaning based on the cash flows, it is the cheapest company out of every major enterprise software company with a free cash flow yield of 4.39. So in summary, when we look at the free cash flow yields of every major enterprise company, Palantir has around half the yield of the average, meaning that on average, it's around double the price of any other major enterprise company based on its trailing metrics. Now, it is true that Palantir may be growing faster, and maybe it will grow its free cash flow way faster than these other companies. Maybe it's all worth it. I'm not saying it's not. I'm not saying that Palantir can't make it worth it, but what I am saying is a lot is already priced into the stock based on the cash flows. Investors in Palantir are assuming that the stock is roughly twice as valuable as any other comparable stock in software. Now, again, that may be the case, but that's quite the assumption to make. Now, again, there's many ways to value a stock. The free cash flow yield's not the only one. We can also do it based on an earnings per share basis. This is where you take the next 4 quarters of the analyst estimates, and then you see the multiple that
I have not heard the word ontology yet. I'm hearing a lot of numbers. I'm not hearing the one word that matters. Maybe that's coming up. I'm not dismissing these numbers. He's kind of going through saying it's expensive. We all fucking know it's expensive. Like, this is not that interesting. I'm curious if Joseph knows what an ontology is, because that really matters when it comes to understanding a lot of these numbers as well. Again, this is good analysis. It's not like the analysis is wrong. I just haven't heard anything other than him reading from this website, which I get, but like, there's got to be something deeper here
that investors are paying for those next 4 quarters of earnings. With Palantir, the forward PE is currently 87.8. So it's almost pushing a 94 PE ratio. We can look at other, again, very great companies, ones like CrowdStrike that have huge total addressable markets. They have all subscription revenue. They're growing very fast. They have still very fast revenue growth that is faster than Palantir's revenue growth. And this stock is still trading at a lower PE ratio. We have one like ServiceNow at a 53. Again, that's compared to Palantir's 88. We have Cadence Design at a 39.4 PE. We have Palo Alto Network at a 53. We have Datadog at a 58. Synopsys at a 34. Microsoft at a 32. Viva at a 34. Adobe at a 25. Intuit at a 32. HubSpot at a 59. Oracle at a 26. Snowflake at a 38. Roper at a 27. Autodesk at a 33. Atlassian at a 48. Workday at a 35. SAP at a 33. And Salesforce at a 27.8. So once again, we find that Palantir has a multiple on its earnings that are roughly double the average of every major enterprise software company, many of which are growing really fast. They have free cash flow that's growing quickly. They have very resilient business models. But Palantir is still worth roughly double. Now, again, you may say that Palantir so far really shouldn't be judged on an earnings basis or even a free cash flow basis, because so far they're just trying to land contracts, they're trying to grow their revenue and grow their reach. They're not super focused on generating profits today. And that may be the case. That's the case often with software companies that are still in the expansion phase. But there's also ways to value it based on pure revenue multiples based on the enterprise value to sales. Sales is another word for revenue. If we look at the relative valuation of Palantir compared to other enterprise software companies on an enterprise value to revenue multiple, you'll notice that one sticks out a little bit from the others. We have here all these companies that we've been looking at, all of these great companies with wide moats, resilient business models, and most of them trade at an enterprise value to sales multiple of around 9.9 times. That is the median across the industry. So just shy of 10 times. Palantir's enterprise value to sales multiple is 27.7. It's over double the median of all of these companies. In fact, it's far more than anyone even close. Even CrowdStrike, for as expensive this company is, it has an enterprise value to revenue multiple of 15.3 against Palantir's 27.7. This should paint a stark picture of what's currently being priced into this stock. And you'll notice here that the one that's supposed to be the loser of Palantir, the one that has all the gloomy sentiment right now, is Salesforce, which on almost every metric is currently the cheapest enterprise stock. But this stark visual should be a reminder of what you're paying for a company. The reason I bring up all of these visuals is just to illustrate that this company is expensive when you base it off of any relative investment. Palantir is expensive on a free cash flow yield basis. Palantir is expensive based on an earnings per share basis, and it's expensive based on a revenue basis. No matter which way you slice it, this company is trading at an extremely rich valuation. Now, I've been very careful in both the title of this video and in the video itself to use the terms expensive and cheap, not the terms overvalued and undervalued, because a company can be expensive and still be undervalued. We've seen examples of that before, where a company looks incredibly expensive and it turns out it was still undervalued at the time. That's happened before. And I'm not saying that that can't happen with Palantir. There is a chance of this company outperforming expectations and turning out to be undervalued. Whether or not a company is truly undervalued or overvalued depends heavily on how much cash they generate in the future.
So we have like 10 minutes left of this. I'm waiting for his take, because otherwise this was a waste of time. I mean, quite frankly, and no disrespect to Joseph, but like, what is your take from this? Because I think he's trying to be super politically correct here by saying it's not overvalued, whatever. We all know it's expensive. Like, there is no Palantir bull that's going to say the stock is not expensive. That is objectively true. But just giving us the numbers and saying it's expensive is like a ChatGPT type. What is the point of the take is what I'm trying to figure out. So we got like 5 minutes left. Let's see if he actually concludes with an argument around the company other than saying it's expensive.
Future. Since we don't perfectly know the future, we don't perfectly know if a company's overvalued or undervalued. But judging whether or not a company's expensive or cheap, trading with high expectations or low expectations, is based on history. Now, I don't bring up any of this to attack your stock or to bum you out if you're invested in Palantir. I promise you that's not the goal. In fact, I've been in the same situation before with some of the companies that I own. For example, Costco. Costco is a very expensive stock based on almost all of the metrics. You look at it at a free cash flow yield, it's at a 1.8%. It's not nearly as expensive as Palantir, but for a company that's more established, it's a larger chain, it's a company that's a retail company, 1.8% is very expensive. It also trades at a 54 PE ratio, which is around double what Walmart and Target trade at. So Costco stands out just like Palantir as being a very expensive company, and I still refuse to sell it. So I knowingly hold a very expensive company. When I look at my portfolio, I look at the companies I hold. I've held Costco for such a long period of time. It's been such a great stock. It's just continued to grow its earnings, grow its cash flows, pay huge dividends at the same time. I'm so much in the green on this stock that I just don't feel like selling a company that has so many things going the right direction. So in many ways, I feel very similar with the way that I hold Costco today, that I think the same way many investors in Palantir feel, where the stock has done so well, you know it's trading up to a very rich valuation, but in many cases, you might just choose to hold on to it anyway. And I respect that decision. The one risk of holding a company like Costco or holding one like Palantir, one that's trading at a very high multiple and a rich valuation, is there's no room for mistakes. There's no room for any holes in the armor of these companies. If Costco is to show any real weakness at all, any problems with the business model, any new competitors that are really threatening its business model, this stock would crater. The stock could go down from a 54 PE to a 30, going down 40% in value. It could go down even further. Costco is currently priced to not have any major challenges or mistakes. And I hold Costco believing that it's not going to have any major challenges or mistakes. I'm extremely confident in the future of the company. I think it's one of the most proven, resistant, all-weather businesses that exist today. So I'm okay holding the company at a high valuation because I think the chances of something wrong with it, something challenging happening with it, are extremely slim. Palantir is currently priced the same way. Palantir is priced in a way where if investors find themselves having any concerns about the future, any changes in forecasts for future expected growth, any problems with competition, any negative turn in their story, and this stock is going to sink. It is not priced for negativity. Palantir is currently priced to have an extremely prosperous future. We also saw the same thing from Morningstar. They're bullish on the stock's future. They think it has a great future, but they're concerned about the valuation. From a valuation standpoint, while our forward-looking estimates testify to our optimism on the name, we remain skeptical of the exuberant valuation at which Palantir is trading. Even without factoring in the sharp rise in the firm's stock price after hours, Palantir remains the most expensive software company in our coverage, with an enterprise value sales multiple of around 20 times. Now it's getting closer to 30. We caution investors that sky-high expectations baked into the firm's current valuation, any small bump on the road can crater the stock price. And they're, of course, correct in that statement. Any bump in the road can cause a huge problem for Palantir. So overall, that was basically it. I thought it'd be good to check in on Palantir as I've been following this company for years and give some updated thoughts on it. Right now, again, I'm not bearish on the company. I think they're doing a great job. I like their product roadmap. I like that they're taking over market share. I like Alex Karp as a leader. I've been impressed by him. So I like this stock a lot fundamentally, but I also think it's good to compare that against what's currently priced in and try to do updated analysis on the risk and reward. And right now, Palantir has shifted into that bracket where I think there's a lot higher risk in valuation than there was just a couple years ago. But I'll continue to follow it along. And
okay, next time Joseph makes a video about Palantir, I'll watch it before I play it for you guys, because that has not been. Oh my God! Look, I love Joseph. I think he's an awesome guy. He's a smart guy, but just reading off the metrics on why it's expensive, I don't think is worth making a video over. I don't know. I don't see any value in that, dude. I really don't. There's got to be some take attached to that. And the take can't just be I like Karp, but the stock's expensive. Like, what is the point of like any idiot can go to Qualtrum or Alpha Spread or any website and just look at price to sales. They don't even have to look at the other metric. Price to sales, boom, 36. Oh, that's expensive. Growth rate 27%. That's also pretty expensive. Like, all right, here you go. Boom, it's expensive. Why is it expensive is something I think Joseph didn't speak to, and I think that would have made the video even better. I mean, he could have made this video so much better by chopping off 5 minutes of reading numbers and just spending 5 minutes on saying, hey, maybe the street is thinking that the ontology is kind of the key differentiator to enable LLMs to provide value. I don't think Joseph knows that much about it, and that's not shade at him. I just, if he knew that much about it, I think he would have mentioned like that core basic one sentence thesis on why the street is getting bullish on Palantir. But it's fair if he doesn't know about that stuff, right? He doesn't invest in Palantir, so he doesn't need to know about that stuff. But I think that would have made the video at least a little bit more juicy in terms of justifying, or at least having a potential justification for the expensiveness of Palantir. Price to perfection, yeah, I agree. Obviously, it's price to perfection. If we screw up on Q3, stock's going to tank. I don't think we're going to screw up on Q3. I think Q3 is going to be pretty good, and I think Q3 is going to continue reaccelerating. I could be wrong, but if that's the case, then I think we should have some more momentum. The title should have been Costco is my Palantir. Yes, that would have at least given him a better take, because his take, honestly, what the take I got from it at the end was Palantir's expensive, but I understand if you're still holding it. Costco's really expensive. I've been in it for a bunch of years. I'm still holding it. That would have been a little bit more of a conducive argument to like getting people to spend their time listening to his analysis, which really wasn't analysis. It was just reading numbers. But if the analysis is, hey, things can be expensive, but you can still own them for a long time, then like, I guess that's a take. Just needed a little bit better of a take there. All right, so that's what we got from Carlson, talking about Palantir and how expensive it is. But yeah, I agree. It is definitely expensive. There's no disagreement there. It's just, I don't think there was anything that interesting in what he was trying to say. Okay, I think that's everyone in this room is now dumber for having listened to it. Oh, that's funny. All right, well, that's what we got with Joseph Carlson. His take, CRM is cheap. He is a Salesforce guy. He is a big fan of Salesforce, and Salesforce he likes, which is fair given Salesforce's free cash flow is incredible, and Salesforce is gaining more momentum. But I do think, the one thing I don't love about Joseph is that sometimes he doesn't go as deep as I would like him to go. He's really big on the numbers, which is great. And it's important to be big on the numbers, but it's also important to know, as we talked about in the beginning of the show, narratives and stories that form around companies. I mean, Joseph should know this better than anyone. He was the only guy singing the narrative around Netflix when everyone hated Netflix, right? And I give him the utmost respect for for hammering down on that thesis. His thesis on Netflix was not really numerical. It was qualitative around they're the only streamer that can really create meaningful content. So there was a story, you know, around Netflix, and there's a story obviously around Palantir. And that story is attracting different investors as well. Eric says Amazon was too expensive for 16 years. Then the PE went down as earnings climbed. Stock never really tanked. Yeah, that is fair. Dude, 2014 was the best time ever to buy Amazon, outside of like 1995. But it was a bit volatile. It just never, even Amazon today, you could argue is slightly expensive, or Tesla slightly expensive. But those PEs will go down as growth continues. But that growth obviously needs to continue. What if next earnings doesn't have perfect numbers? We go down, I buy more shares. Well, that's the thing, right? It's a double-edged sword. It's like if Palantir falls to like $25, I just think there's so many long-term investors, including institutional investors, that are going to be excited to buy more. And it's like, all right, boom, there you go. If we get a really bad dip, you get longs that get excited to buy, having made sure nothing crazy happened with the thesis. If you are relatively flat, it's like, okay, we're still up 120% year to date. If we expand to 40 or 45, it's like, all right, the party continues. And so I think that, you know, I think there's a variety of outcomes that can be beneficial there as well. Chad says, wait until Netflix buys AK Media. All right, so speaking of Chad in the chat, we will tentatively have, it's a good word, right? It's a good word. It's not a horrible word. Tentatively, that's a nice word. We will tentatively have Chad and a couple other people from Palantir on the Thursday stream. So make sure you're here, probably 4:15 market close on Thursday. Palantir recently launched DevCon, which is like AIPCon, but for developers. And Chad and a couple people are going to be on the channel talking about DevCon and showing off some of the things that they're working on at DevCon as well. By the way, Palantir put out this video right here. So let's listen to this video. It's a 1-minute video. And so we'll get some coverage on what's going on in the world of DevCon. In general, why is DevCon important? Because Palantir needs to get all these developers to evangelize their software. And to do that, you need to have conferences, just like AWS and GCP does for developers. And so this is Palantir's first real big attempt at that.
Builders, I'm so excited that you're here watching this video, because that means that you want to join us at our first ever DevCon. So how do you earn a spot? The DevCon Fellowship. Your challenge, should you accept it, is to build the most ambitious, exciting project that you can on top of the platform. What problem you solve is your decision. What data you use is your decision. And how you present your solution is your decision. I know it's vague, but what we're really excited about is to see your creativity shine through. Some tips for how to think about it. Number one, anchor around a real problem and craft a narrative around how your solution solves that problem. Number two, if you're new to the platform, spend some time getting your feet under you before you start. We've included links to learn.palantir.com so that you can learn more about the platform and how to wield it. Number three, check out my colleague Jag's video, also linked, for inspiration on what you could build. For more information on how to submit, how the contest works, and the full rules, see the info below the video. Time to get building. See you out there.
Pretty cool stuff, dude. I'm happy that they're starting to get the builders involved, because AIPCon is really for investors and for customers, but DevCon is a little bit more for, I put in the chat right there if anyone wants to imply, for the actual developers that are using Palantir software to build some cool stuff. Speaking of developers, I saw this tweet today, which I thought was really interesting. So this is from an account that is saying this week's analysis, which will touch on the flooding in West Africa, is starting to link up with our past analysis of Russia's involvement in Africa. Very cool to see these links start to come up in the graph as the data set grows. Shout out to Palantir for enabling this. So it looks like they're building an application on top of Foundry to be able to amalgamate all the data in regards to West African floods. And so I thought this came across my screen today, and I was like, wow, you're starting to see like people in the real world use Foundry AIP to actually build some core elements of data analysis around certain things that they care about, in this case, West Africa floods. And they're using Palantir as the software stack to do that. So I think DevCon's gonna be really exciting. Hopefully on Thursday we get Palantir, we get Chad and some of his Palantir friends / employees onto the show, and we'll get some deeper updates on what's going on with DevCon. Cool. Michael says Joseph's strategy is to buy what Wall Street's love: Costco, Netflix, Microsoft, etc. Not cheap stocks. He used to call Nvidia bubble too, and it was funny coming from someone who holds CMG. Yeah, I've noticed his style is also buying these kind of blue chip names that you can't go wrong on. Like you really can't go wrong buying Costco, Netflix, or Microsoft. Like over 5-6 years, you probably are not going to go wrong buying those stocks. But that's why I love Palantir. Palantir is contrarian, right? It's not the Wall Street favorite, even if it's becoming the Wall Street favorite. And that's, I don't know, that's just more appealing to me. Same thing with Tesla. It's more exciting. Maybe it's because they're run by founders. Maybe it's because they're so unique and eclectic and eccentric, but it's attractive to me. Same thing with Robinhood. I would put that in that bucket as well. But the companies are starting to show real growth, and that real growth is meaningful. Now, in the context of Palantir, again, it is expensive. But the thing that Joseph also didn't talk about too much is that they have a chance to grow into this valuation. I know he mentioned at the end, if Palantir messes up even one little thing, they're going to get hammered. I agree with that. However, I think what would have made his video a little bit better is if he said how they could grow into the valuation. But that's where you have to talk about AIP. You have to talk about these extensions. You have to talk about what they're doing in the government. You have to go really deeper to make that analysis, which is not easy to do, especially for someone who probably doesn't care about going through all that work because he's not invested in the company. But that would have painted a little bit of a better picture on the potential ability for them to grow into 85 billion, even if we don't see multiples expand on earnings. But I think if that happens, then, Palantir obviously can't stay expensive, but it can potentially even be undervalued given the growth and where it comes from. Okay, cool. I think that's pretty much it. Do we have any other headlines? Do we have anything else going down? We ended out September. Relatively green month for September. Is there anything else crazy going on? Any headlines? No, nothing to. Oh, this is the last day of Q3 as well. This is the last day of Q3 too. So stocks that hit 52-week highs today: Alibaba, Lockheed Martin, Home Depot, Lowe's, Verizon, Interactive Brokers. That makes sense. JD, Public Service, etc. So those names hit 52-week highs. And I forgot, today's the last day of Q3 as well. So Q3 is officially done. Now we're entering into Q4. Tesla FSD rolling out into Cybertrucks as of yesterday. Oh, that's incredible. That's amazing. That'll be fun. The videos of those will be really fun. That'll be great. And then, port strike news, that'll be out tonight. We'll cover that tomorrow on the market open. It'll start off 12:01 a.m. And so we'll see kind of what happens. Tom says, why would you want anyone who doesn't understand the company to give that projection or opinion, though? Well, but that's the point of being a content creator, right? You're supposed to. I didn't know anything about the yen carry trade. I learned about it, and then I tried to talk about it the best I could. But my point is just like, again, I like Joseph. Me and him are friends. Like, we talk. But just doing a video saying, look at all these numbers, it's expensive. For me, at least for people in the chat, I guess, maybe for the broader audience that watches him, which he has a very big audience and he's worked really hard for that audience. For someone like me, who rarely watches a Palantir video from anyone else outside of like Arnie, to be honest, because I just like, a lot of them don't really give me enough juice to get excited to watch it. It was a waste of time. And I'm sure it was a waste of time for everyone in the chat. However, if he had brought up some explanations, because he would have done some research on the government business, the ontology, what it means for them to accelerate growth, to grow into the expensiveness, that would have made me a little bit more excited to at least listen to his perspective on them being expensive versus just saying, hey, look at these numbers, they're expensive. Like, for me, that's just a waste of time. That doesn't do much for me. But for the 50,000 people or whatever that's going to watch it, they're probably going to get some value out of seeing that Palantir is expensive. I just don't know if there's any conclusion to that other than it's expensive. But that would be my perspective. Amit still doesn't know about the yen carry trade. You're not wrong. You're not wrong about that. Damn, you're still live. Yup, we are still live. We covered JPow. Might as well have just gone live until the market close. And that's why we continue to stay live. Where is Bitcoin right now as we close out the quarter? Bitcoin. Wow. Bitcoin. Look, it's down from 66, but it's up from 63 at 63.7. So a little bit of momentum into the close, but nothing too crazy. S&P 500 right here, 573.76, 573.50 after hours, which is not too bad. All right. I think that's it for me. We'll be back tomorrow on the market open, starting off October. Got 5 days till I go to India. show goes on in India. I think I'm going to miss a couple days for the market open, but outside of that, we will be live every single day, same time, 8:45 a.m. Doesn't change for you guys. Eastern Standard. Market close will not be happening. That definitively, there's no way I'm going to be able to do that, except maybe on the 10:10 event and stuff like that. I'll pop it because it'll be like 2-3 a.m. my time. But besides that, nothing should be too different, and we'll keep going from there. And that's pretty much it. All right. Thank you, everybody. Hopefully you had a good day. Strong end to the month. And now we get into October and see if we can keep this up and continue gaining momentum. All right. Thank you, everybody. Appreciate it. Amit Jobs is out for today. Just kidding. But still kind of looks like Amit Jobs. All right. Thank you, everyone. I'll see you guys tomorrow, 8:45 in the morning. Bye, everybody.